An excellent cup of tea often inspires a great story. This is a story of Global Tea and Commodities Limited. My name is Lalindra De Silva. I am the Financial Controller of Global Tea and Commodities Kenya Limited. We are by far the largest tea exporter in Kenya and probably in East Africa as well. Plus, we export tea to various countries such as the UK, the Middle East, West Africa, South America. Literally, you could find our tea all around the world. We have a wide range of teas, and by far we are the market leaders in the premium segment. Kenya has been one of the largest tea producing countries in the world. So us as Global Tea, we have strategically placed ourselves to ensure that the Kenyan tea reach to its proper destined customers, especially in the European markets, in the UK, where the Kenyan tea is found in almost all supermarket shelves. Our group as a whole has employed close to 1,000 employees and bettering the livelihoods of our fellow Kenyans. Out of that, 60% are ladies. That creates a ripple effect on their families. What about the youth? You have so much of people working in the port. We need drivers, we need turnboys. So all these employment opportunities come up, and also when you're loading the teas, the tea industry, also Global Tea, with the amount of volumes we generate, has had a positive impact on Mombasa. We've been with Absa for quite some time. Our relationship really took off last year, where we got into working capital funding with Absa. The facilities which we enjoy from Absa has helped us grow our business in the last year tremendously. Today, the current trade environment in the world is ever changing. We face so much of challenges, from delays in shipping lines, to getting the teas out, to foreign currency problems. One of the rainbows in the storm has been Absa's TMO system, where now we don't need to send physical documents to the bank anymore. We just need to upload the documents on the Absa system and our job gets done. Our invoices get discounted within the same day the payments come through. It's a system which have clearly understood a need in the market and has been a game changer. Absa is a bank which understands the client's needs. They understood what Global Tea required. When you start growing, you need a bank which can fund that growth as well. Absa was the first bank put their hands up and say, we would like to partner with you. Looking back 30 years ago, from starting from one warehouse to setting up the largest tea processing plant in East Africa, we have come a long way. That has been our story. There are so many pages more which needs to be written, and I am extremely happy that Absa has partnered with us. Together, we can write the next chapter of our story. A story which involves growth, employment opportunities, more funding coming into the country, and taking Kenyan tea to the next level.
CN Flowers was established in 1993. The inspiration for the founders was climate was ideal, the workforce was ideal, and also our access to the European markets was there where most flowers were being sold to. My name is Peter Chesrem. I'm a director with the CN Flowers Group, one of the largest producers of cut roses in the world, particularly spray roses. We have got 4 farms across Kenya. So about 60% of our flowers go to Europe, both to the auction and also to direct customers who are selling in supermarkets and wholesalers. We grow not just roses, but we also grow summer flowers as well. And we're also now moving into packed at source bouquets. Our partnership with Absa has evolved over time because initially when we started off, I said in the early 90s, they assisted us to set up the different initial farms, and they've continued to help us to expand to the new farms as well. With our wide supply across the world, it's important to have a banking partner like Absa because of their financial muscle. We're able to have that support as we grow. Absa has provided us with loan facilities, especially when we're setting up our new products, expanding the farms, establishing our irrigation systems. They assisted us to engage in projects such as setting up our solar plants across the 4 farms. We're able to cut 40% renewable energy across our farms, which will go a long way towards ensuring that in the future that our environment is actually kept clean and good. We employ over 2,500 employees across our 4 farms. So the biggest impact that Absa has had on our business was actually during the COVID-19 pandemic, because we actually laid off 0 staff. And even for our customers, they knew that if we could get through that period unscathed, there was actually a lot of room for growth and they could rely on us. So the future plans of Sian Flowers is we want to actually make 90% of our exports to be bouquets. It's going to be a massive project, but we know that with Absa, as we've been through the last 25 years, we'll be able to achieve goals and ensure that for the coming decades, we'll actually be able to meet our market needs. Absa has taken the time to understand our story. They've been with us from the beginning when we started off on 20 hectares, and now we're over 200 hectares. Because of that, we are confident that the future for Sian Flowers is bright.
Good morning, Peter.
We believe in ideas that can change the world.
Every dreamer, creator, striver, and believer. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us, because your story matters. Absa.
Our stories begin right here, and we never write them alone. There'll be pages we love to read again and again, and some we want to tear out. They are stories of dreamers, stories of creators, stories of strivers, stories of believers, and we're inspired by them all. We invite you to write your story with us. Your story matters, Absa.
So, good morning once again. I think we can now start off the session. Good to have you. For the clients who are still outside, we are requesting you kindly step in so that you can be able to start off the session. I think firstly is to really appreciate you coming this morning. I know it takes a lot of time and sacrifice, for you to be able to share, take your time and be able to come with us. There are so many things I know you'll be doing in your offices, and you volunteering to do that, taking this time to come with us, we totally appreciate. So maybe as we start off, if you are sitting at a table where there's someone else, you can extend a greeting, get to know the person as we start in the next few seconds. So just say hi to the person in the table, get to know who they are. I can see some people are not saying hi to their friends. Oh, you know each other. Thank you very much. Thank you very much. So my name is Victor Warunge. I'll be your MC for the event. And happy again and really appreciate you coming to us. I think without further ado, we'd like to start off with the program for the day. And with that, we'd like to invite our director and head of trading to start off with the opening remarks. So with that, please welcome Wolfgang Omondi.
Good morning, everyone. As I was ambushed to make these opening remarks, I was wondering, what do I refer to our guests as? So do I say clients, customers, and I zeroed in on partners. And I think partnership is really really the key to this, this particular engagement, because we are there to support you and also learn from you, because it's only through that you know, we sort of get better and continue on this journey. But having said that, you know, on behalf of the Absa leadership, our CEO, and then the broader CIB team, led by James again, and the markets team, led by Director and Head of Global Markets, Stella Mambo, we welcome you to this annual event. We call it the Absa Upskill and Economic Update. And in this forum, we basically try to unpack some of the emerging trends that we have probably seen in the past and try to make projections for the future and also identify some of the risks, you know, and maybe the possible mitigants for them. So on behalf of the Absa leadership, again, I would just like to welcome you to this event and thank you for taking time off your busy schedules. And I hope that the engagements will be fruitful to you, and from there, you know, we just continue with our journey forward. So that's it from me. I welcome you once again. Thank you.
So thank you, Wolf. So as we proceed with the session, and I think we can first recognize the senior leadership from Absa. So if you don't mind, you can stand up and then we can see you and I can introduce you. Sophia, Wolf. Thank you. You've already had Wolf introduce himself. He's our director and head of trading. Thank you, Wolf. And then now we have seated next is Sophia Hassan. She's the director and she heads treasury in Absa. So thank you very much, Sophia. So we'll be looking definitely as we do this session to get to share from Absa what the outlook is in terms of the economy. We are hoping you take notes. We are hoping you will engage the team that will be sharing, our economists, our panelists, for those questions where you are wondering what will be happening in the economy. If it is SHA, if it's SHIF, it is GDP, you know, anything, if it's inflation, feel free to engage the teams who will be coming here. So we're happy to unpack, those economic, macroeconomic factors and outlook. So hoping for an enjoyable session. And again, with that, I think we can move over to our first speaker. His name is Pumelele Mbio. He's our Absa senior economist. He sits in the Joburg office. So please let us welcome Pumelele Mbio.
Thank you very much. The title of my presentation says Sector Rotation Amid Incipient Signs of La Nina's Impact. The sector rotation that I'm going to talk about relates to what we are seeing as a differential performance in different sectors of the economy. Whilst the agricultural sector has been decelerating, we expect that some other sectors of the economy are going to be recovering, and that is going to allow the economy to recover to more or less the long-term growth trend that we've seen in Kenya over the last 10, 15 years. Of course, GDP growth disappointed in the third quarter of last year, but we think that there is scope for the economy to recover, for GDP growth to get back to about 5%, which is the average that we see over the next 3 years. La Nina has been characterized as being weak. However, it's expected to be at its most intense during the first quarter of this year. That suggests to us that there is going to be some upside pressure on inflation. However, there are no signs that there are underlying inflation pressures in the economy. As a consequence, while inflation will likely get to about 5% by the third quarter of this year, we think that the central bank is going to continue to ease the monetary policy stance. As far as the currency is concerned, broadly speaking, it's likely to be more or less stable, but with a slight depreciating bias over the rest of this year. Part of the reason for our thinking like that is that it's been evident for quite some time that there's been more than sufficient capital inflows into the economy, so that despite the country running trade deficits, large trade deficits, foreign exchange reserves have actually increased to near historical highs. That suggests to us that there shouldn't be any reason to be concerned about the currency. However, there are risks to this rather constructive view. And those risks emanate from developments elsewhere, not developments within the Kenyan economy itself. The trade war could have implications not only for economic activity, but also for financial markets. And it's very difficult sitting here right now to have any sense of what the impact of that is going to be. But overall, it seems very likely that it could lead either to maybe moderately higher inflation, but it could also lead to currency weakness as well. There's also other factors that I'll touch upon later on. This is basically a summary of our forecast for the Kenyan economy. We think that GDP growth, as I indicated earlier, which was at 4% in the third quarter of last year, we think it's going to accelerate to about 4.9% this year, and then on average over the next 3 years, averaging about 5%. Inflation has bottomed out. It is rising. Most of that upside pressure is actually coming from food. If you look at core inflation for the 7-8 months up until February has basically been bobbing around 2.2%. That suggests that there are no underlying inflation pressures in the economy, and it's unlikely, highly unlikely, that you're going to see an acceleration in underlying inflation pressures in the economy. By the end of the year, we expect that the policy rate will have, the central bank rate, will have been dropped to 9%. We actually think that it will get to 9% during the third quarter of this year, and then the central bank is going to keep it at that level for the remainder of the year and going into next year. Why are we so confident about the recovery in economic growth? Well, for one thing, what's been evident for quite a long time is that GDP growth in Kenya is driven largely by consumption spending. On average, in the last 10 to 15 years, GDP growth in Kenya has averaged about 5%, 4.9% thereabouts. 3.8 percentage points of that has come from household consumption expenditure, from growth in household consumption expenditure. That suggests that household incomes have grown on a sustainable basis at a very robust pace. There's no reason for us to think that there's going to be any disruption to that trend. Household consumption expenditure is likely to grow at a fairly fast pace on a sustainable basis as far as we can see. If you look at the other components of GDP, they do not add that much to GDP growth. Investment spending typically contributes about 1.2 percentage points to GDP growth. And government consumption expenditure contributes a little bit, and net exports detract from economic growth given the fact that Kenya is a net importer. Why is it that investment spending tends to be so low or tends to contribute such little to GDP growth? One of the factors that we can identify is that there just isn't enough domestic savings to finance investment spending in the economy. If you look at countries that are typically characterized by high investment spending, like China, India, and so on, they tend to have a high savings rate. Those countries typically, at worst, have investment to GDP at about 15%. What is also noticeable is that savings also typically is around that sort of level. Most of those countries typically have savings upwards of 20% of GDP. If you look at Kenya, savings in Kenya, which is the chart that you see on the right-hand side there, typically is less than 10% of GDP, even less than 5% of GDP. With such little savings, it's very difficult for the economy to be characterized or to be driven by investment spending, because it means that in order for the country to invest significant amounts, it has to attract foreign capital because it cannot generate enough domestic savings for that. So investment spending in Kenya is not a significant driver of economic activity. It has not been a significant driver of economic activity over the last 10, 15 years. And we think that there is nothing that is going to change with respect to that. I'm not going to go through all of these slides here, but you are free to get a copy of this presentation from our colleagues later on, should you desire to look at it. As far as the sectoral rotation that I was talking about, 2023 and 2024 was unusual for the agricultural sector. There was a strong rebound from the recession that was experienced in 2022, and GDP growth in the agricultural sector and its contribution to GDP growth was higher than it has been the norm historically. Now, there's evidence that there's a deceleration in growth in the agricultural sector. If you look at high frequency indicators, particularly agricultural exports, those indicate that there has been a significant slowdown since 2023. If you look at things like flour exports, fruit exports, and others, they do indicate that there has been a slowdown in the agricultural sector. Of course, there's La Nina, which, although it's been characterized as being weak, suggests that there is going to some restraint in agricultural production over the course of this year, especially in the first quarter of this year and the first half of this year. While that is happening, there is some evidence and reasons to think that there are other sectors of the economy that are going to recover and help to support economic growth. If you look at the construction sector, growth in the construction sector has been persistent, stable for a long period of time until we get to about 2022, when it stagnated and actually eventually got into recession. However, what we like to point out is the chart on the right-hand side there, because it indicates that cement consumption has been picking up, which suggests that activity in the construction sector is picking up. We think that there's a strong likelihood that this pickup in activity is going to continue, and that is going to help to support overall GDP growth. If you look at financial services also has been depressed, or the growth in financial services has been depressed, which is not surprising given the fact that monetary policy was tightened as much as it was during 2022, leading to 2023. However, the central bank is easing the monetary policy stance, And we anticipate that activity is going to pick up in the financial services sector. Credit growth peaked around 13%, and by November last year, there was actually contraction in credit. With the easing of monetary policy, we've seen market interest rates, market yields coming down significantly. Treasury bill yields have come down significantly. Bond yields have come down significantly as well. That is part of the transmission that we anticipate is going to lead to an acceleration in credit growth and overall activity in the financial services sector. There are also reasons to believe that other sort of cyclical sectors of the economy, particularly retail and wholesale trade, that there is going to be a pickup in economic activity as the central bank continues to ease the monetary policy stance. Why are we confident that the central bank is going to continue to ease the monetary policy stance? Well, primarily two reasons. Inflation is low. Yes, it's rising, as I indicated earlier on, but most of that pressure, that upside pressure of inflation, is coming from food, which is not surprising given the fact that there has been this deceleration in the agricultural sector, which is also not surprising to expect that going forward there could be some further upside pressures on food inflation given the influence of La Nina. However, as I indicated also earlier on, core inflation has been very stable at a very low level. Given the fact that credit growth has been so depressed, it suggests that the tightening of monetary policy was very effective at restraining domestic demand, which is one reason we think that even as food inflation is rising, that is not going to translate into higher underlying inflation pressures over the course of this year going into next year. So there is scope for the central bank to continue to ease the monetary policy stance. By the third quarter of this year, we anticipate that the central bank rate will be at 9% and that the central bank is going to leave the policy rate at that level over the rest of this year going into next year. The other reason we are fairly confident that the central bank is going to continue to ease the monetary policy stance is our expectation for the currency. What I'm showing there on the right-hand side is a range of forecasts, our forecast as well as consensus forecast from the market. The thing to note about that chart is that the range of forecasts is quite wide. The second thing to notice about that chart is that there's a broad expectation that perhaps the exchange rate is not going to decline from where it is right now. And that's reasonable, given the fact that the central bank has been consistently in the market buying dollars on a consistent basis. If you were to look, we're around 129, let's say, what's more likely over the next 12 months, 119 or 139? Probably 139 than 119, because the central bank is in the market buying dollars and it's helping to prevent the appreciation of the currency. What has been a source of strength for the currency has been the fact that there's been more than enough financial inflows to finance the current account deficit. So much so that FX reserves, during the course of 2023 going into 2024, they rose to near historical highs. There's no reason to believe that that dynamic is going to change. There are risks, though, to that view. Perhaps the most important and most pertinent is whether or not the government is going to, first of all, successfully complete the final review of the IMF-funded program. Secondly, whether or not they are going to agree to a new funded program with the IMF. Those are that's one of the near-term risks for the currency. Bear in mind that one of the factors that led to significant capital inflows that helped to support the currency has been the inflow of foreign portfolio money into the local T-bill and bond market. A lot of investors have been fairly constructive in their view of Kenya, in spite of the fact that there are debt sustainability concerns because of fiscal policy management. In essence, you could view, for example, the fact that the government was able to issue the Eurobond and the demand for that Eurobond was so strong as evidence that the market essentially anticipates that the government is going to complete the program successfully and that they are going to engage in negotiations for a new program. That is a baseline assumption that the market has made. If that doesn't pan out, given the heavy positioning of foreign investors in the local market, there, of course, remains the risk that some of that could flow out, and that could exert some upward pressure on the exchange rate as a consequence. But I highlight that as a risk, not a baseline assumption, because as I say, there is no reason to believe that the government is not going to successfully complete this review and that they are not going to engage in negotiations for a new program. The other risks that are worth highlighting is with regard to the trade war that has been started by the US administration. It's very difficult to get a sense of what the impact of this is going to be. There's been a lot of speculation in the media about the possible impact of tariffs on inflation, but I'm more concerned about the possible impact of tariffs on economic activity. You've probably heard the story that in order to make a car in the US, the parts that go into that car crisscross the border between Mexico, the US, and Canada several times before the final car is made. Well, if you have a trade war, that supply chain could be severely disrupted. And I'm more concerned about the potential for that trade war on that supply chain. Can add China to that story as well. So to me, it seems highly probable that a trade war is going to have more of an impact on economic activity than it will on inflation. In addition to that, you have to remember that the Federal Reserve has tightened monetary policy quite substantially before they started easing last year. But if you compare the level of the Fed funds rate with where inflation is in the US right now, it's clear that the real Fed funds rate is quite high. High in a historical context, high in relation to what the implicit forecast or judgment of FOMC members as to what the neutral real Fed funds rate is. Most FOMC members basically think that in order to keep inflation from stable, in order to keep economic growth stable, the real Fed funds rate has to be about 1%. Well, actually, the real Fed funds rate right now is above 1%, it's closer to 2%. What that implies is that monetary policy in the US is quite restrictive. There has been a noticeable slowdown in activity, particularly if you look at non-farm payrolls. Non-farm payrolls have decelerated and slowed down quite significantly. And if that slowdown continues, you could actually get to a point where the Fed is going to be more concerned about economic growth than it will be about inflation. So if you juxtapose that against a trade war, then the real concerns should not be about inflation, but about economic activity. And bear in mind that US equity markets, global equity markets have rallied quite strongly since 2009. And if you are going into a recession potentially, What happens to risk sentiment? It's going to deteriorate. What happens when risk sentiment deteriorates? There's a flight to safety. Where's that safety? Safety is in the dollar. What that implies for emerging market currencies is that potentially you could have those currencies depreciating significantly. Again, I highlight this as a risk rather than as a baseline scenario in terms of what our thinking is. There are other risks out there, particularly with respect to the impact of La Nina. It could actually turn out that meteorologists are incorrect or wrong about their assessment that La Nina is going to remain weak, and that it's actually going to intensify, and as a consequence of which you could have the impact on agricultural activity, not only in Kenya, but in the region as a whole, being more severe than seems likely at present. And the consequence of which is that not only would economic activity be depressed, but also there could be higher inflation than we are focusing at this point in time. That could lead to the central bank not easing as much as we anticipate. I'm going to leave it at that point, and I'll open the floor for questions.
Good morning. Thank you very much for this presentation. Just some comments, and I'd just like to see what your views are. As much as you've presented a very, what I call, rosy picture, you know, the reality on the ground is, and we were talking about it amongst ourselves, that the economic conditions in this country, and I'm talking about really not high-level stuff. I'm talking about really low-level where people are consuming. I'm talking about the general public. What we see out there, there's a pressure on people's income, and I'm talking about across the board. Whilst as much as, you know, there has been some increase in the salary levels, and you talk about 3.8% and all, I'm not sure if that really translates into spending at the consumer level, because people are really tightening their belts. How does that tie up with what you are saying here? Because, I mean, on the ground as FMCG people, we find that there's pressure on demand. Inventory is going up. There's not that much sale taking place. People are trying to do fire sales or discounts or whatever just to keep their head over water. So I don't know. I mean, there seems to be a disconnect. That's number one. Number two, you know, I've been in the foreign exchange business trying to exchange my earnings from exports all the time, and your dealers will attest to it. And every time I speak to them, they give me something and it happens the opposite. What happens is we don't seem to be conforming to classical economic theory. You know, what do I mean by that? You know, normally you say depreciation should be a case of the inflation of your trading partners and yourselves, and the delta should be what the inflation should be about. It's not coming through. So as exporters, we find ourselves at a disadvantage. I mean, yes, we went to 160 and we were all kind of smiling. It dropped tremendously down, I mean, in a very rapid session, but the cost did not come down. So there are issues that don't conform to what I call classical economic theories, but more about what's practically down there. How do you tie those two together?
Right, very interesting comments there. On the demand story, it's quite amazing that when we speak to individual business people, even individuals, people, workers, they express exactly those sentiments that you expressed. That it seems like the consumer is under severe pressure. It seems like with taxes having been increased, with all these new levies having been imposed, that the consumer is under severe strain. However, it's very difficult to corroborate that through the available data. Even survey data like the Purchasing Managers Index, it doesn't quite corroborate that. I mean, there are some elements of it which it does corroborate, but overall, it still paints a picture of very strong growth in economic activity in the country, which is surprising to me. I would have expected that, given the sentiments that you typically hear, that at least the survey data would be corroborating that. And even if you look at the survey data that is collected by the central bank rather than the Purchasing Managers Index, it also corroborates something similar, that economic activity remains strong. So I don't know what is causing this disconnect. When business people are being surveyed for the purposes of the surveys that the central bank conducts, or the surveys that go into producing the Purchasing Managers Index, that doesn't come up. Some elements of it get corroborated in some of the individual sub-indices of the PMI, but overall you're still left with a picture that says that overall economic activity is growing strongly. So I don't know how to reconcile that discrepancy. It might well be that those businesses or those business people who are suffering complain the most, and those who are doing well don't tout their successes but when it comes to actual surveys, they actually reflect, that gets reflected in. I don't know. I honestly don't know. The other question was on the exchange rate and whether it's being driven by fundamental factors or not. I would agree with you. That there is a discrepancy between the actual performance of the currency and fundamentals like inflation differentials and interest rate differentials and so on. If you were to look at purchasing power parity, if you were to look at inflation in Kenya relative to its trading partners, go back to 2008, let's say, and say, okay, how has Kenyan inflation performed relative to its trading partners? How has labor costs or unit labor costs or any sort of cost measure in Kenya relative to its trading partners? The exchange rate is way lower than where it should be according to those measures. Now, that leads to people or institutions like the IMF, for example, saying that the currency is overvalued, and some other institutions as well come to that judgment as well. I'm sympathetic to that view. I'm sympathetic to the view that the currency is overvalued. However, the difficulty again comes when you look at actual economic performance. GDP growth has been consistently around 5%. Maybe if the currency and several other factors, if the currency was weaker, if several other factors were different, then you could actually have much higher GDP growth than the 5% that we've been getting, that I'm celebrating and I'm touting as being, rosy. So there is, even if you look at things like employment, there are some analysts. We had a chance to chat with an external MPC member, and he raised this possibility as well, that employment in Kenya looks rosy, but there's a significant amount of underemployment. There are people who could be more productive than they actually are in the labor force. And of course, there's a huge informal sector as well. So it could very well be that the currency, together with other factors, are actually restraining economic activity. Or in other words, if the currency were weaker and if these other factors were addressed as well, the economy could grow at close to 10% rather than at 5%. So that's the only thing I can say about that. But in terms of why the currency can remain overvalued sustainably for this long, I have no idea. I honestly have no idea. But one thing that I would highlight is that perhaps also tied in with the assessment I made earlier on that the economy is driven by consumption spending. Also, if you look at the production side, it's an economy that is heavily driven by services rather than by industry. Again, that probably speaks to the currency overvaluation story. If the currency is overvalued, there's probably going to be more depressed conditions for the manufacturing sector than there will be for services overall, not just financial services, but for services overall. So a strong currency doesn't have the same impact on the services sector than it does on the manufacturing sector and other industrial sectors. All right, seems it. Oh.
Good morning. Could you elaborate a little bit about the U.S. policy, that the impact that it will have a direct impact in Kenya? What could be the consequences that will affect, especially direct to the manufacturing companies? Because I believe there will be some interruptions on the policies that are passed in US. So we needed to at least elaborate how this would affect us in Kenya's manufacturing.
I mean, the one constant about the policy pronouncements from specifically from the president, and not specifically the administration, but from the president, is that they are characterized by a great deal of uncertainty. That makes it very hard to get a sense of what the impact is going to be, or even what the final policy is going to be, because one day you hear an announcement being made, and then several days later it's been retracted and it's been reconsidered, whatever. So there's a great deal of uncertainty with regard to what the final policies are going to be, and what the impact of those policies, even if we were to know what they are, what they would be. I suspect that as far as Africa in general is concerned, the biggest impact will come primarily via exchange rate movements. It's very difficult, as I said earlier, to have any sense and any sort of conviction with respect to what that impact is going to be. I worry, as I said earlier, I worry overall about the impact of these policies on overall economic activity in the US and globally. In terms of sector-specific impacts, it's very difficult to have any sense of what the final outcome is going to be, what the final impact is going to be. So as far as Kenya is concerned, I would say that watch out for general risk sentiment globally. If there is a deterioration in sentiment because evidence mounts that the US economy is slowing down, that is going to have an impact potentially on the currency. And that is probably going to be the most evident impact that you're going to see as a business operating out of Kenya. In terms of what trade policies will impact Africa or will impact Kenya specifically, it's very difficult to have any sense or any conviction with respect to that.
Just to give you some insight from this side. So from a manufacturing point of view, and again exporting, you know that Kenya is one of the largest garment manufacturing exporters to the US. One of the things that is not clear so far is the extension of AGOA, which is due to expire in September 2025. Now, September 2025 is literally 6 months away. Supply chains in the garment industry tend to be something like anything between 6 to 9 months in advance to get the fashion, to hit the markets that are required. So we are now at that cusp. We're at the cusp where we don't know whether the extension of the AGOA will take place or not. What does that mean? It means that you're going to have jitters in a very large manufacturing sector that employs almost 100,000 plus people. So what's going to happen to them? So that's one risk that I kind of look at. The second thing is that we had a large diaspora in America. There was a lot of remittances that were coming to Kenya from people who live in the US to their families here. With what's going on with the immigration policies there, we're not sure how much of that is going to affect that inflow because of the status of people being out there and the ability of them being able to send the money back this way. So those are the kind of two things at least that comes to my mind immediately. And the third one is the pronouncement of the President of the US that says very clearly, if they are imposing a tariff on us, we will impose a tariff on them. Now that is a very broad line threat. Obviously, we know that when there are goods coming into Kenya from anywhere in the world, there are import duties coming in. We don't have an FTA like we have with the EU in terms of the EPA and all that, or with UK or whatever. We don't have one with the US. There was one being negotiated, but that's come to a kind of halt with the last administration. So there are some headwinds that we may have to be considering from a local standpoint of view rather than from a global standpoint of view. Obviously, the global matters that you brought on will affect us because of the global trade situation that will take place. But from a Kenyan-specific point of view, there are 2 or 3 factors that might affect our economy based on direct impact. Thank you.
Yeah, thanks for that. But I still, I mean, you probably implicitly agree with me that there's so much uncertainty right now because we don't know, as you say, we don't know. I mean, they might be reluctant to extend AGOA, or even maybe at best, they might delay the process of coming to a conclusion as to whether or not to extend it, so that September comes and maybe it only gets extended in March next year or something like that. So there's so much uncertainty with respect to these trade policies. You've got these broad announcements, but it's not clear how they are actually going to translate into actual policy. Are they going to go and look at every country that has trade relations with the US and say that if you're imposing import duties on us, we're going to impose import duties on you? It's so uncertain.
Just to let you know, the USTR, which is the US Trade Representative's Office, has been instructed by the president to look at every country. So it's not about just a broad line brush. He's actually said, look at every country, see what they're charging you so that I will charge them back for the same. I mean, it's that broad.
Yeah, but it still leaves a great deal of uncertainty. That's the thing I would highlight.
Yeah, morning again. So I'm Wolfgang. I'm the head of trading at Absa. And I just wanted to chime in on the piece around the currency, purely from an observational perspective. So one of the things that we've seen, especially on the import side, maybe due to the higher rates you touched on, so less demand from the manufacturing side, which means that, the import component bit was sort of subdued. But on the positive side, I think with the rates where they were, even though they've come down, we did attract quite a bit of portfolio flows into the market, which also served to give the shilling, a shot in the arm, so to speak. In addition to that, of course, we've seen, the IMF reviews come through, and those have also largely been positive. In addition to that, we did see the Eurobond restructure a few days ago, and you saw the amount of interest that it elicited. I mean, it performed at the rate of about 3 times, so 4.9 billion, and the government accepted 1.5. Point being that there's still quite a bit of flows that sort of come this way. Now, one would ask then, why hasn't the shilling strengthened? And this is probably, what would explain is the central bank have been actively buying. So if you look at the movement in reserves over the last 5-6 months, they have actually been growing, even though we've not seen much into, specific credit, external credit. That has contributed to that stable zone. And behaviorally, as whenever the shilling appears to strengthen, they come in to buy quite aggressively. When it appears to weaken, they come in to sell. So almost like they're kind of protecting another thing. They're kind of protecting a certain level, so to speak. One other thing was also the G2G. If you recall, when we were at our worst in terms of foreign currency liquidity, we had, the government launch a G2G. I have to admit that I was skeptical at the beginning, but it seems to have worked because in terms of the oil flows, it seems to be better managed, and with that, again, we see less volatility. But in terms of the outlook, I completely do agree. There's still quite a bit of uncertainty around, Donald Trump, like you mentioned, and the tariffs, around even debt sustainability, because it just requires, one statement from DT around IMF, and then we blow out again. So there's quite a bit of uncertainty, and I guess, we'd need to figure out how to mitigate that or position going forward. Thanks.
There's one here.
Good morning, all. There was a point which has been mentioned around AGOA. Now, just to give a perspective on AGOA, US doesn't have a choice but to go with AGOA. There is a reason. Because if we look at the overall textile, apparel, and fashion industry at this point of time, there's a transition which is happening. The big key players are basically predominant in China, India, Bangladesh, and southeast region of Indonesia, Vietnam, Cambodia. Now, if we look at one by one, US is of the view to move out of China. India, with a very high consumption rate, is not going to get that market which is coming out of China back in India. Bangladesh, Pakistan is in turmoil. Vietnam, Indonesia, Cambodia, the capacities are full, the labor rate is going up. That leaves only one continent, which is Africa. And considering that, AGOA has to go and extend it. When it is going to happen is a question mark. That's part one. Part two, we have been discussing a whole lot of things, but one point which I would like to raise and which hasn't come in across so far, US is moving out from a world leader position. The world order is changing. What is the impact of it? What kind of Pandora boxes are we going to see?
Well, that's a very difficult question. Very broad and very difficult question to address. I think, I'll tell you the perspective that I take. As an economist, I take into account what I know now. So what do I know now that tells me about what's likely to happen tomorrow, next year, in 2 years' time? But then I have to factor in some of the things that is unknowable, perhaps. There is some uncertainty, a great deal of uncertainty about a lot of things. Some of these things might not have an immediate observable impact. You know, the change in global leadership, global world order that you're talking about, there won't be an immediate observable impact. And certainly there won't be an observable impact on economic performance. So from a strategy point of view on your side, as you think about, as you plan, those are things that you have to think about. Those are things that, as business people, you have to think about. But unfortunately, I can't give you any guidance with respect to that. But all I can tell you is what my view is about the things that are happening now, that I can observe, that I have a fairly strong conviction about what their impact is going to be in a year from now, 2 years from now. So unfortunately, I can't give you any sort of guidance there.
I do understand that point of yours, because it's very difficult to assess that piece, and it is still shaping across. It will evolve. What you mentioned about 2 years might take us almost the same. But one thing which is going to happen, in my view, over, say, next year and a half, is the European turmoil because of the US moving out. And that creates a lot of uncertainty, which unfortunately I haven't seen in your presentation, how to address that. What would be the impact it is going to have on Kenya? USA to Kenya has been stopped. What impact it is going to have both on your household consumption and other activities which is happening in Kenya.
Yeah.
So those are some of the points which is amiss in your presentation. And I understand one of the gentlemen did spoke about from a FMCG perspective. And if you look at all those pointers in perspective, there are things which technically should have been here, but is not there.
Yeah, so I mean, as I said, there are things that I can incorporate in my baseline forecast. There are things that I can't incorporate in my baseline forecast because they are so unknowable. The risks, I mean, to me, the factors that you're pointing out are some of the risks that are inherent. Some of them I can't evaluate. You know, the change in global leadership. You know, what happens with in the relationship between the US and Europe. Seems like Trump is cozying up to Putin. What the impact of that is going to be on the relationship between the US and Europe, and what the broader implications of that are for economic activity going forward. It's very difficult to assess that, but it's something that is worthwhile highlighting as a risk factor. But you still can't, at this point, from my perspective at least, you can't make any assessment as to what the potential impact of that is going to be, which is why I highlight it as a risk factor. All right, thank you very much, ladies and gentlemen.
So thank you very much, Pumelela. We can give him another round of applause. Definitely some great insights. So maybe for your noting, the session will still be open. We'll be having a panel discussion later after the break. But again, the break will come after the next speaker. So make sure you get prepared, prepare for questions, and then definitely be able to have that unpacked. Then I think maybe just to note, for those who will be asking questions, you can also be introducing yourself so that you also get to know who you are. So maybe before you introduce the next speaker, I think I can introduce some bank executives in Absa whom hadn't introduced. I've seen Stella, Alex, Eunice. Maybe you can stand up. So thank you very much. So on my right, we have Stella Mambo. She's our director and the head of markets. Give her a clap. And then on this side, we have Eunice Kuria. She heads commercial. She's the head of commercial in business banking. We can also appreciate her. And then finally, on this side, we have Alex Ojong. He's the director and he's the head of global market sales in the Africa region operations in retail and business banking. So feel much welcome. And I think with that, we can now move over to our second speaker, and she is the head of client solutions in Africa regional operations. So please welcome Vuyo Mafrika.
Good morning, ladies and gentlemen. There is a Chinese adage that, translated into English, says, "May you live in interesting times." And what I've come to understand is that in the culture of its origin, interesting times would mean a time of turmoil and turbulence and, a little bit of anxiety. And then I looked at something. I came in March 2022. On the 7th of March 2022, dollar KES was 114.18. In March 2023, it was 128.60. In March 2024, it was 143.50. It's the 7th of March 2025, and it's 129.20. I mean, there is no better illustration of interesting times as that. But I believe that when I sit in this particular audience and I come to this particular country, that the captains of industries, which are yourselves, wear the spectacles of opportunity. And therefore, this cycle, the up and the down, is something that we take in our stride. My name is Vuyo Mafrika. I am the Director of Client Solutions Africa. My dynamic team and I assist our clients across Africa to manage various exposures that they have on their balance sheet, I think predominantly on their cash flows, that would arise from risks such as foreign exchange, which is our bread and butter, interest rates, commodities, equities, and credit. I think I stand here today in a room of Kenyan exporters, and I would have completely missed the mark or not been able to read the room if I did not focus my discussion today on foreign exchange. So today, I'm going to skip. Today, our discussion is going to focus and center primarily on some of the risk management mitigants that we have available for managing foreign exchange. We're going to walk a bit of a journey showing some of the products that we have together with some illustrative examples of how clients have fared having used our product. I think when I step off, I'm going to also leave some space for my colleague, Rui Molefe, who is our senior legal counsel, to give you some color with regards to the documentation of some of these structures. I think it's very important that we also have the documentation talk, because these are contracts we sign. In our suite of products for foreign exchange, I always say, and in this particular audience, I'm only going to speak to 3, but there are the short-term hedging instruments and the long-term hedging instruments. There was a time, I think, in this market where a lot of exporters would hedge out about 2 years. But I think the interesting times that we live in have suggested a bit of a rein-in of that hedging horizon. So I am of the view that the hedging horizon for Kenya now is more in the medium term being in the 12-month range. What we're going to be speaking to first and foremost is forwards. Forwards are the backbone of our hedging products. And then to speak to some option-based structures that are of a reduced premium. I think on the far right, I've spoken about purchased options and cross-currency swaps. Those remain tools that are available in our arsenal. I am not of the view that today's particular conversation warrants that we delve into them. But given how we work and interface with our clients, should there be a requirement that we delve into that part of the product suite, we will definitely walk you through those as pertains to your company and your company's specific needs. That said, I think another thing that I'd like to highlight is that when faced with foreign exchange risk, always, always, always leave some room for spot. You have to leave some of your conversions to be converted in the spot market. Spot gives you that flexibility that should the market move in your favor, you can take advantage of that. But that said, in markets as volatile and as dramatic as they are now, it is also extremely prudent to have a hedging strategy in place. I want to start with the forward exchange contracts, which I said are the backbones. I think many of our clients here have used forward exchange contracts. With foreign exchange contracts, as an exporter, you simply lock in the level at which you will sell your foreign exchange in return for shilling. But over and above the thinking of locking in the rate, I think what remains crucial is a view of the underlying to the foreign exchange contract. A foreign exchange contract, when done by an exporter, is in essence a placement of KES. You are in essence depositing your KES with the bank when you do foreign exchange contracts. Because at the time that you enter into a foreign exchange contract with the bank, if today we agree that you will sell me $1 million in June, as a bank, today I assume that you have sold me $1 million. So the hedge that I do as a bank today is to go sell the $1 million I had in the bank now, because you've promised me $1 million in June. But in order to sell $1 million in the market today, I go borrow. When I've sold that $1 million today and received KES, I take the KES that I need to deliver to you in June and place it on deposit. That means that when you come in June to sell me your dollars, then I can make whole the position I took on the day we undertook the promise, because I sold dollars on the promise that you will make me whole with dollars. But I will also lift the shilling that I had placed on deposit and give them to you in June, because that's the day you said you were going to need the shilling. And that's why doing a forward exchange contract as an exporter is in essence a shilling deposit. So when do you want to do more forwards? When shilling interest rates are higher. Because then you are earning more of an interest rate differential. So if you look at how much you were getting as an interest rate differential when dollar KES was 143, relative to where you were earning interest differentials today, forwards were far more advantageous last year this time because one, interest rates were higher, and two, the exchange rate was also slightly higher. But let's not discount the interest rate element. So if you look at the forward exchange contracts here, and we've only shown out to 12 months, the 12-month forward exchange contract looks like 94. That does not mean that Absa is of the view that dollar cares will be 138.94 in 12 months. It simply means that the effective interest that you've earned in shilling will ultimately give you an effective conversion rate of 138.94. That means, put differently, you have taken a shilling deposit of 12.3. You would want to do it, perhaps, at this time. Why? Because there is a view that shilling rates might pull back, meaning that if you do the same trade for 12 months and you do it after there's been a rate cut, you will earn less interest in your forward exchange contract. But that's, I think, something that is important to infuse into your thinking about why you would do the forward exchange contract as an exporter. I think that there remains merit as well in doing a portion of your conversions in forwards. The trick, I believe, with forwards is the timing and the tenor. It is important to do your forwards at a time when you see a little bit of volatility in spot so that your starting point is higher, and then when interest rates are elevated so that you earn more on the carry. So when you go into things such as dividend season, we're going into the June period, the guys who pay divvies start lining up their dividend forwards around March, April. You'll see a little bit of noise. I say this cognizant of what my colleague Wolfgang had pointed out about how the currency is being stabilized. But even then, there is still merit to look out for a little bit of weakness in the spot market and to time it so that it's not just after an MPC meeting that delivered a rate cut. I think many in this room are familiar with the zero premium collar. But I think if I had to explain it quite simply, what a collar does is that first and foremost, it protects a minimum conversion rate for you. That they refer to as the floor level. That's your minimum conversion level that you would lock in for a given period. Now, if you had used purchased options, then to protect that minimum floor level, you would have had an outlay of premium to protect that floor level. But when you use a collar, instead of outlaying some premium on day one to protect a floor, you give up participation in favorable moves towards you as an exporter past a specific level. So you set yourself a maximum best case conversion level. So with a zero premium collar, you which looks like your minimum protection level, and then you have your best case, which is your cap. In between the floor and the cap, you are free to go and buy in the spot market. But once your cap level is reached, that's your maximum conversion level. So it's slightly different from the forward exchange contract because with the forward exchange contract, you had one level, and that was your binding level. Whereas with the zero premium collar, what you have is you have a range in which you can participate. You set a floor, and you say, if dollar cares is below this floor, I'm protected at the floor. But if it goes above, then I can sell at those better levels in the spot market. But once you get capped out, you are forced then to sell at the cap. You have the cap because it's that cap that pays for the ride on the floor. So we've priced here, for example, if I look at a 9-month forward, your floor level that you'd protect is relatively the same as today's spot. So you're saying, I do not want it to get better than this. And if it gets better than this, so worse for the importers but better for you, then I want to be able to buy. So if it goes to 130, 131, I want to buy. But once it reaches 136, I cap out. So if it goes to 140, then I'm forced at 136. If we go back to the FEC, the FEC at 9 months just kind of locks you at one rate. I have a case study here of a client that did a zero premium collar with us. It was executed last year in December. The client is an exporter, such as yourself. They came in and locked in a 6-month horizon. So my sentiment about the pulling back of tenor is becoming very evident. A lot of exporters are hedging 6 months, 12 months max. So locked in a 6-month hedge with us and locked in a floor at 130. And then we've given that client the upside, the cap, at 135. So if we look at where we are today, then they are selling to us every 2 weeks at the 130 level. So they are doing slightly better than where spot is. If it dips further down, they are protected at the 130, but they kind of cap out at 135. And if you listen to the view from Pumelele, from a macro perspective, there's a view that there'll be some stability, but there's so much event risk that's currently in the system that there's also room for a little bit of volatility. I don't know, Trump might say something else, and then we find a bit of a spike. And if that spike were to happen, they can participate. And on the inverse, something great could happen, and things improve. We saw that happen last year when the Eurobond switch happened, and it was timed around the same time as the infrastructure bond. Overnight, the shilling just appreciated. If something like that happens again, and the sovereign is undertaking liquidity management, then they get to be protected at 130. And then this is where the magic happens. Geared collar. I will start with a disclaimer. I like gearing. But when I first entered the bank, I was a credit manager. So I'm also very prudent about the use of gearing. If ever you use a structure that has gearing, my view, and it's a view that you will find most credit managers across the banks would hold, it must never exceed 30% of your forecast earning. That's a credit view. Regardless of what your hedging policy looks like, etc., once you have gearing, let it never be for more than 30% of your forecast revenue. When do you want to use gearing? You want to use gearing if you are sitting in the room and having looked at the vanilla structures. So we start with our FEC, we've looked at our collar, and if having looked at the vanilla structure, maybe you feel I'm still below my budget rate, then it's time to perhaps start engineering a bit and consider the use of gearing. How does the geared collar then work? It still has the floor. So it's still a collar. It's just been jazzed up a bit. It still has a floor, so it still has a protection level. You can still get protected if the currency appreciates through your floor. So your starting point is protection. So even when the bank prices you a geared collar, ensure that your dealer gives you the starting point as your budget level or your worst case level. Then you participate, and then you get capped out. The danger is when you get capped out. When you get capped out, then you have to deliver more dollars to the bank than what you would have had under a normal zero premium collar. So under zero premium collar, if you had committed to sell $100,000, when you get capped out, you are forced to sell $100,000 at the cap. If you are in a geared collar, when you get capped out, you have to sell $200,000 at the cap. So there's asymmetry when you're using a geared collar. Your floor is set for $100,000, which is what you wanted to sell, but you cap out for 2 times the notional. You can vary the gearing. So you can gear for 1.5 times the notional. So for example, in the SA industry, with our South African rand clients, that currency is volatile the entire time. So we tend to tell clients in the SA market that you don't know who's going to sneeze. Do not gear past 1.8. 1.75, 1.5, because the currency itself is very volatile. The shilling has a different nature. It's very steady. In fact, I've always had a look, and I've been working the Kenya market since dollar shilling was 87. So I'm also giving away my age. And it has done a steady depreciation of between 3 and 5% per annum since. So it will always depreciate, but it's been very gradually, very well behaved. I think this misbehavior started post-COVID. But by and large, it's always been a very steady currency that just depreciates slowly. And I think we're seeing that starting to come back. Look, the orange man has introduced a new set of risks for us, but we've seen that steady hand of the shilling come back. So there, because we're here, I would look at 2 times gearing. I would not look at 3. In fact, I think if somebody did 3 times gearing, I would probably ask the dealer to please have me on the call. And I'd probably come on the call to talk you back to 2. Right? Because I think if you increase the gearing, you increase your minimum selling level. But what you don't want to do is now to introduce operational risk to your business. Another thing that I'd want to also emphasize on these structures is that these structures can be restructured. So if it so happens that you've taken out one of these instruments and suddenly the market has moved adversely, or your cash flow projections have moved from a date perspective, this is a very easy structure for us to relook at. We've had clients who've entered into collars, and then, especially if they are long dated, and then halfway through, the market dynamics have shifted so much that we reprice them. So we've had times when we've maybe booked at one range, but the currency has depreciated and we've had to increase the range. And likewise, if the currency starts appreciating sharply, we can increase your protection level if there's room to do that. So once you have one of these structured instruments alive, I think once it's alive, it's alive. So there's also a need to dynamically reassess it. I mean, I think it's our middle office, PTS here, will give you a monthly valuation of how the mark-to-market is faring. But together with the monthly valuation, your sales dealer from markets will have a conversation with you to say, look, you have some expiries coming. If I look at this, here's an opportunity for restructure. So once we enter into these structures with you as an Absa team, we walk the journey with you. So it's never going to be one where there's a soccer team that says, what, you never walk alone. So on these, we walk the journey with you. I'm going to go into yield enhancement, but I wanted to take a pause because I guess we're going to switch gears when we go into yield enhancement. So I think it would probably be a good moment now to take a pause and just get some reflections on the room with regards to how have you fared as exporters in this environment of so much shilling strength, and how have you experienced hedges? And most importantly, I would love feedback as to your thoughts about the appropriateness of the structures presented in this particular market and to yourselves as our esteemed clients. So I'm going to pause for a minute or two, and then I'm going to start looking for volunteers. Any thoughts? Okay, now I'm going to start calling people out like the maths teacher. Victor, you are an Absa sales dealer, and you have many client conversations discussing these very structures. Can you give us some insights as to some of the conversations you've had with clients on zero premium collars? What have some of the concerns been that have been raised, and how have you walked the journey with our clients?
Okay, thanks. Thanks, Vio, being the math teacher. So we've had engagements definitely with a number of colleagues when it comes to hedging and risk mitigation. And some of the concerns maybe the clients would raise would be coming from last year, the last couple of years, where we are used to those top rates of 160, maybe dollar shilling and all that. So there's always that feeling that, okay, this currency might again do the similar move. I get locked in at that, say, 135 level cap, and I will not be able to participate. So those are some of the concerns customers raise, and there's always that feel with the workings of how government is. There is fear that we might be able to see those levels coming back again. That has been the major concern for particularly these particular customers.
Okay, thank you. Thank you very much, Victor. I would never pick on clients. That's probably why I've gone home. Thank you. I wanted to touch, this is my parting kind of product idea here. And it's a yield enhancement tool that takes its nature from the world of options. So as an exporter, you are always sitting with a portion of dollars that you need to convert for the use of your shilling expenditure. So what a DCD does is that the bank requests that you place your dollars with us. So you place them with our money market desk, and then you give us the right to buy your dollars at a specified level. Because we have the right to buy your dollars, we then owe you a premium for those dollars, or for that right to buy your dollars. Now, what we do then is that we invest your dollars with the premium, with our money market, and therefore enhancing your pickup in terms of what you'll earn on money markets from having invested your dollars with us. And at maturity, so at the end of the tenure of the deposit, to the extent that the exchange rate has gone past the conversion rate, then we will come and buy your dollars at the conversion rate. And to the extent that the dollar shilling is below that, we will return your dollars. So I'm putting up here an example, and then I'll also walk you through a case study. This is a structure that works really well for a very short tenor. So I would not use it for longer than 1 month. You are kind of in the 1 to 2 week tenor when doing this. If you placed $500,000 with the banks, this is on a 7-day placement, and you provided the bank with the right to buy your dollars at a rate of 129.29. Then, to the extent that dollar cares is trading below 129.29, you will get your dollars back. To the extent that it depreciates past that level, then the bank will pick up your dollars and give you cash. In using the DCD, your yield goes from 3.45 on a vanilla money market deposit for 7 days to 15.6 annualized because of investing that additional premium. I have a case study here of a client that used a DCD. This was a 7-day one done in 2024. The conversion rate was 129.08. The money market yield was 3.75. You can see the yields have pulled back since the rate cut. And through the DCD, then we enhanced the yield to 18.6. That's as a result of investing both their initial notional together with the premium we owed them. So if you look at it in rands and cents or dollars and cents, what they would have earned on the deposit for the tenor on 7 days would have been $364. But due to the use of the DCD, so having also placed the premium, they earned 1.8K in dollars as interest, and so there was a pickup on it of 1.4K in dollars. So it's small wins, but it's a lovely cash flow management tool. It's a cash flow management tool that we find is particularly easy to use when you have a conservative hedging policy as an institution, so where you don't do long-dated hedges. And you can also use it in that portion that you left for spot, because by and large, you would only want to use a DCD to enhance the yield on the dollars you were going to have to convert anyway. Because if you don't get converted in a DCD, then usually the clients, where we return their dollars to them, they then do a spot transaction. So it's usually for if you had a salary payment and you knew you had to do the conversion, or you needed to pay local expenditure, then you would use the DCD because it's a quick money market instrument, but it is used on that portion of dollars that you would have been okay to receive either dollars or shilling. And more likely than not, you were going to need to receive shilling. So I'm going to end my presentation with you here. I think we could spend the entire day on our suite of products, but I thought that it would be very timely to give you a view in terms of what are we terming our products of choice in the current market condition. I think this remains a conversation that we need to extend with you as our clients. We need to have this conversation and flesh it out. All these structures get customized to your cash flow profile, to your dates, etc. And most importantly, they get customized in line with what your budget rates are, what you are looking for as a conversion rate on your dollars. So this is our ideation session, but what we ask for from you as our clients is further engagement as we look to implement these ideas. Not only these, but whatever it is that's in our suite of products that is suitable for your business needs and your risk appetite. I'd like to thank you here, ladies and gentlemen, for your time. Thank you for your attention, and thank you for the warm welcome, Absa Kenya team. Thank you.
Morning all. I think, while we're on the subject of proverbs and adages, I think one of the most important ones that we get from a legal perspective is that the best preparation for good work tomorrow is in fact to do good work today. And today's good work, I think, ladies and gentlemen, is to make sure that you have your arrangements in place to be able to take advantage of the opportunities and the products which I think our team has set before you today. There's some amazing opportunities that that exist in the current market, and there's nothing worse than missing an opportunity to manage both your risk or to take advantage of any yield enhancement opportunity that comes up, just because you haven't done the legwork to ensure that you are appropriately placed, or you haven't contacted your banker to ensure that your documentation is in place for that particular arrangement. I'm going to take you through a couple of the agreements that would apply, or that you would need to see at a particular, at any point when you want to transact or enter into the products presented to you. And I think it's very important to understand that these products that these documents are actually available, and we are able to sit and discuss them with you, or go through them with you as and when required. I'll start very quickly just on the deposit confirmation, which is obviously the DCD and several other forms of deposits that we normally use. Now that's dealt with on a transaction by transaction basis, right? And what you get is, we've developed a standardized and simplified document that applies across all of Absa's jurisdictions. It incorporates the terms of the underlying transaction that allows for that yield enhancement, and it's presented to you as a single document that you are able to review and are able to go through, and which we are also more than willing to obviously discuss and through negotiations finalize with you. That I think will obviously happen on a case-by-case basis when you approach your banker for that particular yield enhancement opportunity. The ISDA is what I'll probably dwell on today, which is what we'll ordinarily use for all OTC derivative or over-the-counter derivative transactions. Most of the products that were discussed here today. We also have the terms of business, which I think a lot of you will have with Absa Bank Limited already, which enable you to do simple products such as FX spot, FX forwards, basic money market. It's a standardized set of documents that also allows you to document simple FX transactions, which are relevant, I think, for the people we have in this particular group here today. Where you have a lending product, what you'll sometimes see, obviously, is some of these terms maybe then be in your facility agreements, and it's possible, if you don't want to enter into a separate arrangement or separate documentation, for there to build in the hedging product terms into your lending agreement, although this would have been discussed with you up front, and that if that is in fact the preference that you have in that particular case. But I'm gonna stop and just go specifically to the standard documentation, which is your ISDAs primarily, because it's one agreement that you enter into, and it's a standard contract that's used to govern all OTC derivative transactions across the world. It's a beautiful document in that obviously, wherever you are in the world, whether you're in South Africa, Kenya, Uganda, USA, Japan, China, etc., it's exactly the same form of document in every single jurisdiction. And so you're able to enter into whatever range or whatever different type of asset class or products that are on offer in terms of over-the-counter derivative transactions. So I see someone's trying to call me. You're able to enter into all of these transactions using one single agreement, which is the legwork that you do right up front, and you put it in place. Now, this can include any types of asset classes. I mean, you can use it to hedge volatile interest rates, currency exchange rates, commodity prices, share prices, investments that you may have as well, all over a single document. And I think for our purposes here today, we're dealing with currency exchange rates, although some of you may want to go a bit further into the interest rate market. Now, the ISDA Master Agreement, the primary purpose of it is that it's a netting agreement, and it allows for all transactions to form one netting set. In other words, all your transactions are dealt with under a single agreement and are seen as being part of a single agreement, as opposed to various separate agreements or documents. Ultimately, though, the most important part of it is that it's evergreen. So we enter into an ISDA today, we do the legwork, we negotiate, we get an ISDA in place. That agreement is applicable. It doesn't create any obligations at that point. So you're not obliged to make any payments until you actually start transacting. You're not obliged to enter into any transactions once you've negotiated an ISDA. But ultimately what it does is it stays in place. And I gave an example a bit earlier that, we have ISDAs with other banks, though, other entities that have been in place since 1996, 1994, and so on. So it's in place forever until such point that you decide to terminate that agreement. And as soon as it's in place, you're able to start transacting with whoever your counterparty is. The ISDA, and I think I've mentioned it a bit earlier, it creates that single agreement concept, right? It deals with that single agreement concept where every single transaction forms part of a single agreement that you have with the bank or with whoever the counterparty may be. It's structured as a master agreement, a schedule, and a credit support annex. This is the stuff that you will generally negotiate as between you and the bank. The master agreement is the same. It contains the boilerplate provisions. It's never amended. The schedule contains the client-specific terms, right? It'll contain the client-specific terms. It'll contain the jurisdiction-specific terms. Sometimes, if you're dealing with a counterparty in the U.S., you may want to put in certain provisions, like if a directive is issued by the president regarding X or Y. I reserve the right to terminate the transactions and walk away. And then obviously your credit support annex will provide for the collateralizing of any transactions should you and the party agree to enter into those collateral arrangements. Now, if you don't put an ISDA in place as between you and the counterparty, what then happens is you can in fact still transact, but through long-form confirmations. Now, long-form confirmations, the main difference between them is that they are simply just an ISDA pulled into a single document. But now you have to enter and go through the credit process every single time you enter into a long-form confirmation. So every single time you'll have to go through the credit process, through the process of negotiating the legals. And we'll normally use them for urgent transactions where we can't put an ISDA together with that counterparty. But essentially, our highest recommendation is that as soon as possible after this, should you feel that you may, in fact, at some point, find yourself in a position where you may want to explore any of the products that were discussed today, start discussions with your banker or whoever manages your relationship within Absa, to start putting the documentation in place, to start doing today's good work, and as soon as that's in place, I mean, all you'll ever see. And I'm just going to shoot past here to the confirmation. It's not as clear as I would have liked, but essentially all you'll be getting from that point forward is a confirmation that contains all of your commercial terms and no more need to actually discuss or debate credit points or legal points required for any transactions. And this is very important. I'm not saying it puts us out of work as lawyers, but the reality is, we also don't want to be negotiating the same legal points over and over with the same counterparty, executing exactly the same transactions. And so some of the things that you're obviously negotiating, and I'm not going to dwell on this, is it's essentially, one, the factors that apply specifically to that client. It's the factors that apply specifically to the jurisdiction, right? In terms of any specific laws. This is one of the things you can discuss up front and get in place immediately. But then it also obviously relates to transaction type. Sometimes a client comes to you and they only want to do a particular set of transactions. So sometimes there's no need then to be adding terms that may in fact deal with other sorts of transactions, like commodity transactions, etc., when they have absolutely no interest whatsoever in that product type. And you then obviously then agree the currencies in which you'll be negotiating that contract, or at least transacting. You agree terms that are important to each of you. It provides for, schedule will provide for your addresses, your client details, the applicable laws, and general like disclosures, for example, such as tax disclosures, etc. And all of that is dealt with in the documentation specifically. And once you have that agreement, and I'm going to just repeat that again, the reality is, once you have that agreement in place, you have an agreement for life, which you can call on and which will enable you to transact, literally be able to transact with absolutely no additional effort. Once obviously we've managed to do all the legwork that needs to be done right up front. And again, ladies and gentlemen, I can't urge you any more than I think I already have, to reach out to your banker and start asking the questions around putting together the documentation in place. And then as soon as the time comes, those terms of business, or that ISDA that you in fact negotiated today when you had a little bit of free time, will stand you in good stead and will definitely make your transacting a lot simpler than it could have been. Thank you.
Thank you, Ree. Thank you, Vio. Maybe another round of applause for both of them. I don't know whether we knew you can be able to get like 15% return on your dollar over 1 week. Did you know? So for those clients who you normally convert, say your flows, and you have a week or 2 weeks to convert, you can give them as a deposit. We pay you a good rate, indicatively the levels of 15. And at the end of the day, you still have a forward rate locked in it. So we have so many capabilities, and some of our colleagues or competition do not have those capabilities. So we are happy to engage further for this meeting in terms of what we can be able to show you. We'll be able to share the presentation with you and be able to eager to have those discussions. So again, thank you very much. At this point, I know you've really learned a lot. And again, thank you very much for even asking the questions. So we'll be doing a tea break. We can give it approximately 20 minutes. And then when you're back, we will have now the panel discussion where we have, the leaders who are customers and part of our colleagues who will be able to, have a debate and be able to ask them questions, and then you can be able also further maybe get to know what is happening and maybe ask them questions. So please do enjoy your break, and looking forward to having you in the session after.
An excellent cup of tea often inspires a great story. This is a story of Global Tea and Commodities Limited. My name is Lalindra De Silva. I am the financial controller of Global Tea and Commodities Kenya Limited. We are by far the largest tea exporter in Kenya and probably in East Africa as well. Plus, we export tea to various countries such as the UK, the Middle East, West Africa, South America. Literally, you could find our tea all around the world. We have a wide range of teas, and by far we are the market leaders in the premium segment. Kenya has been one of the largest tea producing countries in the world. So us as Global Tea, we have strategically placed ourselves to ensure that the Kenyan tea reach to its proper destined customers, especially in the European markets, in the UK, where the Kenyan tea is found in almost all supermarket shelves. Our group as a whole has employed close to 1,000 employees and bettering the livelihoods of our fellow Kenyans. Out of that, 60% are ladies. That creates a ripple effect on their families. What about the youth? You have so much of people working in the port. We need drivers, we need turnboys. So all these employment opportunities come up, and also when you're loading the teas, the tea industry, also Global Tea, with the amount of volumes we generate, has had a positive impact to Mombasa. We've been with Absa for quite some time. Our relationship really took off last year, where we got into working capital funding with Absa. The facilities which we enjoy from Absa has helped us grow our business in the last year tremendously. Today, the current trade environment in the world is ever changing. We face so much of challenges, from delays in shipping lines, to getting the teas out, to foreign currency problems. One of the rainbows in the storm has been Absa's TMO system, where now we don't need to send physical documents to the bank anymore. We just need to upload the documents on the Absa system and our job gets done. Our invoices get discounted within the same day the payments come through. It's a system which have clearly understood a need in the market and has been a game changer. Absa is a bank which understands the client's needs. They understood what Global Tea required. When you start growing, you need a bank which can fund that growth as well. Absa was the first bank to put their hands up and say, we would like to partner with you. Looking back 30 years ago, from starting from one warehouse to setting up the largest tea processing plant in East Africa, we have come a long way. That has been our story. There are so many pages more which needs to be written, and I am extremely happy that Absa has partnered with us. Together, we can write the next chapter of our story. A story which involves growth, employment opportunities, more funding coming into the country, and taking Kenyan tea to the next level. An excellent cup of tea often inspires a great story. This is a story of Global Tea and Commodities Limited. My name is Lalindra De Silva. I am the Financial Controller of Global Tea and Commodities Kenya Limited. We are by far the largest tea exporter in Kenya and probably in East Africa as well. Plus, we export tea to various countries such as the UK, the Middle East, West Africa, South America. Literally, you could find our tea all around the world. We have a wide range of teas, and by far we are the market leaders in the premium segment. Kenya has been one of the largest tea producing countries in the world. So us as Global Tea, we have strategically placed ourselves to ensure that the Kenyan tea reach to its proper destined customers, especially in the European markets, in the UK, where the Kenyan tea is found in almost all supermarket shelves. Our group as a whole has employed close to 1,000 employees and bettering the livelihoods of our fellow Kenyans. Out of that, 60% are ladies. That creates a ripple effect on their families. What about the youth? You have so much of people working in the port. We need drivers, we need turnboys. So all these employment opportunities come up, and also when you're loading the teas, the tea industry, also Global Tea, with the amount of volumes we generate, has had a positive impact on Mombasa. We've been with Absa for quite some time. Our relationship really took off last year, where we got into working capital funding with Absa. The facilities which we enjoy from Absa has helped us grow our business in the last year tremendously. Today, the current trade environment in the world is ever changing. We face so much of challenges, from delays in shipping lines to getting the teas out to foreign currency problems. One of the rainbows in the storm has been Absa's TMO system, where now we don't need to send physical documents to the bank anymore. We just need to upload the documents on the Absa system and our job gets done. Our invoices get discounted within the same day the payments come through. It's a system which have clearly understood a need in the market and has been a game changer. Absa is a bank which understands the client's needs. They understood what Global T required. When you start growing, you need a bank which can fund that growth as well. Absa was the first bank to put their hands up and say, we would like to partner with you. Looking back 30 years ago, from starting from one warehouse to setting up the largest tea processing plant in East Africa, we have come a long way. That has been our story. There are so many pages more which needs to be written, and I am extremely happy that Absa has partnered with us. Together, we can write the next chapter of our story. A story which involves growth, employment opportunities, more.
Our stories begin right here, and we never write them alone. Sometimes we write them with someone who puts our story first. Other times with someone who puts their own story first. There'll be pages we love to read again and again, and some we'll barely remember. Sometimes we feel like the hero of our story, and other times, not. There are stories of dreamers, stories of creators, stories of strivers, stories of believers, and we're inspired by them all. That's why we invite you to write your story with us. Your story matters.
An excellent cup of tea often inspires a great story. This is a story of Global Tea and Commodities Limited. My name is Lalindra De Silva. I am the financial controller of Global Tea and Commodities Kenya Limited. We are by far the largest tea exporter in Kenya and probably in East Africa as well. Plus, we export tea to various countries such as the UK, the Middle East, West Africa, South America. Literally, you could find our tea all around the world. We have a wide range of teas, and by far we are the market leaders in the premium segment. Kenya has been one of the largest tea producing countries in the world. So us as Global Tea, we have strategically placed ourselves to ensure that the Kenyan tea reach to its proper destined customers, especially in the European markets, in the UK, where the Kenyan tea is found in almost all supermarket shelves. Our group as a whole has employed close to 1,000 employees and bettering the livelihoods of our fellow Kenyans. Out of that, 60% are ladies. That creates a ripple effect on their families. What about the youth? You have so much of people working in the port. We need drivers, we need turnboys. So all these employment opportunities come up, and also when you're loading the teas, the tea industry, also Global Tea, with the amount of volumes we generate, has had a positive impact on Mombasa. We've been with Absa for quite some time. Our relationship really took off last year, where we got into working capital funding with Absa. The facilities which we enjoy from Absa has helped us grow our business in the last year tremendously. Today, the current trade environment in the world is ever changing. We face so much of challenges, from delays in shipping lines to getting the teas out to foreign currency problems. One of the rainbows in the storm has been Absa's TMO system, where now we don't need to send physical documents to the bank anymore. We just need to upload the documents on the Absa system and our job gets done. Our invoices get discounted within the same day the payments come through. It's a system which have clearly understood a need in the market and has been a game changer. Absa is a bank which understands the client's needs. They understood what globality required. When you start growing, you need a bank which can fund that growth as well. Absa was the first bank to put their hands up and say, we would like to partner with you. Looking back 30 years ago, from starting from one warehouse to setting up the largest tea processing plant in East Africa, we have come a long way. That has been our story. There are so many pages more which needs to be written, and I am extremely happy that Absa has partnered with us. Together, we can write the next chapter of our story. A story which involves growth, employment opportunities, more funding coming into the country, and taking Kenyan tea to the next level.
Good morning, Peter.
We believe in ideas that can change the world.
Every dreamer, creator, striver, and believer. At Absa Corporate and Investment Banking, we are invested in your story, and we invite you to write it with us, because your story matters. Absa.
Our stories begin right here, and we never write them alone. Sometimes we write them with someone who puts our story first. Other times with someone who puts their own story first. There'll be pages we love to read again and again, and some we'll barely remember. Sometimes we feel like the hero of our story, and other times, not. There are stories of dreamers, stories of creators, stories of strivers, stories of believers, and we're inspired by them all. That's why we invite you to write your story with us. Your story matters.
A few things to give away. We just want to have a good way of, we are feeling generous today, so we have some few gifts for us. Check concentration even during the previous sessions, and then move on to the panel session. I'm also inviting those who are still outside. You can come in with your tea, so to speak, and then we can go on. Okay, the chairman is there. So where is the vice? Is that Shale? We have some fire. Moto. Okay, scan. I hope I'm not coming in between you and the scan. Brian, has yours worked? Avocado. Okay, yeah. Where is avocado? Oh, avocado. Okay. Wamunyoro. Well, there are some villages here we shall know today. So please scan. That is a village in some part of the mountain. Yeah, okay. You're building up this almost a dozen names. Mimi, wewe, tumekuona. Okay. Kishash is what now? JR. Okay. Let's add to the names. Some I may need to not to read. Veggie. Yeah, exporters, we really respect you because I know you quite a room of vegetable exporters here. And that's why you can see the languages of avocado is inclined to the diet. Thank you. We have Maish. All right. Let's ramp it up. For those who have just come in, do scan. And let's run these. Waiting for this to double. How many people are there? 14. We have 14. Let's get it to 30, and then we can move. DAI, I see you. Samak, Oya. We are slightly past the halfway mark. If we get to 20, I'll just start, but I don't want to lock out anybody. So just see whether you can place the scan there. Let's have, we are at 20. The Absa banker, and that is a segue to my sentiment. Colleagues are excluded, so you should be an Absa partner, not the banker, really. So colleagues are not allowed to participate. My colleagues will not participate with this for our clients. We are at 23. Can we get 7 more and close? We have Adani. Hey, okay. It's all about... Okay. All right. I see another one must attend. Okay. And I see you. We are at 24. 6 more, and then we roll it up. Or 5, 2 more, 24. Okay. Ready to run? 22. Okay, we'll close this in less than a minute so that we also move on to the next session. Mr. Allocations, I see you. Shaolin, Mr. Kutenga. Okay. We are 22. So we start in less than a minute. In 30 seconds, we'll start these. Are you ready? I'm waiting for your approval. Are you ready? You're ready. Okay. 22. That's a good number. One last one to go. 22. Okay. Let's get the questions. 24. Any last one? Then we can get rolling. We can roll the questions, see how that pans out. 25. Let's see when the questions, they'll start in a moment. 26, 27. Okay. We are submitting the last moment, like tax returns. Okay. All right. 25 is a good number. Yeah, you can start them. Thank you. So let's see the questions. We are just taking your attention to the first level. So query in 3 and in 1 second. The first question there. Which is the nearest Absa branch location from here? So it's to remind you of our geography. Where? Sarit, I see Sarit, ABC, Queensway. All these are Absa Bank branches. Which is the nearest one from here? 27 answers. Okay, thank you. All right. Scoreboard, let's see where the Wamonyoros. I see. Okay, Gen Z, we see you. All right, the next one, question 2. A solution not offered by Absa Bank Markets. The Eurobond. Spot. Credit linked notes. And M-Shwari. M-Shwari. Who doesn't want an overdraft? Okay, let's see the Gen Z. Okay, you see you're still topped up there. TJ, Mimi, Adani coming up. Let's see the next question. There are 7 questions. So you still have an opportunity if you haven't seen your name there. The purpose of Absa is doing what? Empowering Africans tomorrow together, one story at a time. We are all here representing many stories. Is this true or false? Okay, let's see that. 31 answers. Let's see whether Gen Z is still there. Kishash really coming up. Kasongo is the highest climber. Let's see the next question. See how far you can climb up. Okay. So name 2 events that Absa hosted recently. There's the Absa Sirikwa Classic and Magical Open, Kipkeino Classic and Magical Kenya Open, Magical Kenya Open, and Absa Sirikwa Classic and Kipkeino Classic. Absa is fully integrated in our stories and in our engagements. So which 2 events did we host recently? Okay, let's see how the scores are coming up. Kasongo is doing it, TJ, Mills, Gen Z still topped up there. Let's see the next query. All right, question 5. So 3 more to go. Which factor does not influence exchange rates in the forex markets? Economic indicators. Fumelele was here, just picking around that. Geopolitics, weather, interest rates. So which factor does not influence exchange rates in the forex market? Okay, 28, 31 answers. Let's see. It's weather conditions. Gen Z, Kasongo, Oya, TJ, we see, okay, DAI climbing. Let's see the next 2 queries. The next one, number 6. So who is the current chairman of Absa Bank PLC? Who is the current chairman of Absa Bank? Mr. Francis Okello, Charles Moshene. All right, the answers are there. Okay. Oh, and some missed it. Mimi, tumekuona. Oya, you see you. Kasongo, strong, Gen Z. So let's see the next query. Thank you. The second last question. You still have an opportunity. How many countries in Africa is Absa Group present? We know some of you are in more than one country. So how many countries in Africa is Absa Bank Group present? 10, 12, 15, 18. Let's see the response is coming in. 23, 24, 28. Okay, how many? 12. So let's see. Yeah, Vuyo told you we have represented across 12 dealing rooms. Gen Z is still you. And let's see now the last query. Which of the following markets is generally considered to be the first to react to economic news? The labor market, property market, market for physical goods and services, Gikomba, and the foreign exchange market. Okay? Generally considered to the first one to react to economic news. In 4, 3, 2, and 1, it's the foreign exchange market. So let's see who takes the top scores. Oya takes, let's a round of applause for Oya. Number 2 is, Kasongo, really coming up strong. And number 1, let's see, number 1 is Gen Z. So, thank you very much. So I told you you're feeling generous this morning. So I'll ask Oya to come on, and I'll ask our managing principal to please hand it over this to Oya. Where are you? Oya, why are you doing it from? Oh, yeah, here she is. Here she comes. Let's celebrate her. Yeah, thank you. You can twist it for the brand, the big brand. Thank you. Thank you very much. Thank you. Where's one and only Mr. Kasongo? Where's Kasongo? Kasongo? Who is Kasongo? Alisema na akaenda. I don't see you. All right, so you'll give me the fourth one. So let's see. We can use the fourth one. It's online. Oma is online. Oh, Kasongo is online. I'm not sure. It could be online. Eh? Please, you can chat us. So in the meantime, let's see. So we need the one before Oya, because it's physically. Kasongo will reach us online. We'll do the handover through our media teams. Who's number 4? You can check that. You'll check that. Okay. So let's Gen Z. Let's see Gen Z. Oh, Gen Z is here. Congratulations. It's always advantageous to sit next to the stage. It seems. Great, thanks. Let's celebrate him once more, and thank you for the participation. I know we'll be sliding into a panel discussion in a moment. My name is George Njoroge. I take care of the global market sales from a CIB perspective, but I'd like to just carve out a minute out of that and invite. It's always good to invite owner of the business. So you have our managing principal. It's called Mr. James again. I'll give him a minute to say hi to us, and then after that, we'll do the panel discussion. You'll indulge me on that? Thank you. So, Mr. Again, I know he's not, we always get him out of that. Let's put our hands together and celebrate him, and then we can move on to the panel discussion. Thank you, James.
George, I was just hoping to come for a free cup of tea and slither away, but thank you very much. Good morning, everyone. Again, it's really a pleasure, and really want to thank you all again for taking time to come and have what in our view is a very, very important conversation on how, as partners, we can work together to just help navigate what is definitely a very fluid market. But the whole purpose of this is just make sure that we all have good stories, and because each of your stories matter, we want to make sure that we play our active part in working with you to solution the opportunities that come in front of us. And what we look at them is look at not only challenges, but also opportunities, so that at the end of the day, both us and yourselves, we can actually come out successful in this market. So I hope you're finding the conversations useful, the panel discussions, etc. I'm really looking forward to then continue working with you during the course of this year and ahead as we collectively grow together and we continue trying to add value to you as per our Absa purpose. So thank you very, very much, everyone. And let me hand back over to George so we can proceed with the panel discussion. Thank you very much. It's Victor.
So thank you, James. So maybe before I call in the panel discussion, I think I saw Anthony Mangi, the former CEO. Maybe you can stand up. We recognize him. The former CEO of Kenya Association of Manufacturers. So thank you very much for gracing the occasion. We really appreciate. So I think with that, we can now move over to the panel discussion. I will invite Vuyo Mafrika. I know you've all met her during the time she was doing the solutions discussion. So Vuyo, we say karibu sana to the stage, and then you can be able to invite the panelists. Thank you.
Asante, Victor. Huh? Ladies and gentlemen, we are now, I think, in the last gear of our event, and I think it's been such a fruitful engagement with you thus far. In the final segment of our discussions, we are going to be having a panel interview. I'd like us to use what Nicholas terms the 4 factorial clap to welcome them as they come through. I don't know if we could maybe practice just before we start calling. Do we know the 4 factorial clap? Haibo. You know the 4? Yes? 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 Okay, that's the 4 factorial. Shall we try it as a room? Yes? Thank you, thank you. So, as we bring up our panelists this morning, if we could have a 4 factorial for each of them as they come up. I'm going to move to this side of the room, just to allow our panelists space to move. Our first panelist up this morning is Mr. Rob Etchells. Rob is the CFO and an executive director of Hemingway's Hospitality Group. He has 20 years of finance experience across several sectors, of which the last 9 years have been at CFO level. Rob spent the first half of his career with listed MNCs in Europe and Asia, and in the last 10 years, scaling privately owned businesses and portfolio companies in emerging markets in Africa. He has worked in Nairobi since 2018 and has been with Hemingway's since 2022. He is a UK Chartered Management Accountant and a graduate of the INSEAD Business School in France. 4 factorials. Our next panelist is Mr. Churchill Ugutu. Churchill is an economist with the IC's Group Asset Management Division. In his role, he covers selected African economies and provides multi-sectoral investment opportunities to the investment team. He has developed relationships with key African policymakers and has interacted extensively with the media, both local and international. Prior to his role, he was the head of research at Genghis Capital, where he provided coverage on the Kenyan economy and fixed income investment opportunities. 4 factorials. Our next panelist is Mr. Karim Dostomed. Karim is the director and sector head of Frigochem and Agriculture. He's a member of the Industrial Promotion Services IPS, and they are keen on sustainable agriculture. The company processes fresh, canned, jarred, and frozen vegetables for the export market. 4 factorials, please. It's a full house today. Our next panelist, Mr. Raphael Kiptus. A seasoned financial professional with over 17 years of experience in the finance and accounting field. Throughout his career, Raphael has been a key contributor to Cian Flowers, where he has worked for over 17 years. He joined the organization as an accountant, progressed to the role of project accountant, and currently serves as the head of finance. In his current role, Raphael has successfully led various strategic initiatives, including the implementation of a 1.7 megawatt solar energy project. This initiative now accounts for 40% of the company's energy consumption and is a critical step toward climate change mitigation. 4 factorials. And last but certainly not least, from the Absa family, I'd like to call up Mr. Michael Alem. Mr. Michael Alem is a senior relationship manager in the coverage unit of Absa Bank within CIB. He has an 18 years long banking career and has worked across various sectors, including the agricultural business, manufacturing, and looking after multinational corporates. Over the last 7 years, he was based in our Mombasa office, where he primarily focused on looking after our agricultural clients and with a deep focus on the tea sector. 4 factorials, please, for Mr. Michael Alem. Thank you very much to my panelists. That was the easy part, and now the roast begins. My first question I'm going to address to you, Churchill. We have heard quite a bit from our in-house economist today in terms of the view on the macro. Would you like to please give us a brief overview in terms of your view on the current economic climate? And if you could please also then zone in terms of your views on where the Kenyan shilling is likely to move and also where Kenyan interest rates are likely to go. Thank you.
Thanks, Vuyo. So I'll start with the macroeconomic landscape. And I agree with the earlier sentiments from the audience that there are some challenges in the economy. This is coming from, we've seen even the numbers that were presented earlier on. So we are looking at where last year was. It was quite challenging based on a number of things, fiscal issues, and also some of the more structural issues in the economy. And we are looking at an average of 4.5% for last year, as per what was displayed there. And the reason, let me start from what happened last year as I get into this year. So we have seen from disposable income has somewhat shrunk vis-a-vis, say, 2 years ago. Seen a number of these levies as structural deductions coming in over and above some of the taxes, which has meant that from a consumer perspective, in as much as households are taking a significant chunk of a contributor to the GDP, but there's some frailties from that perspective, and also to a certain extent businesses. And that is starting to trickle into the GDP numbers that you saw even last year. And we heard about what you call the core inflation. So core inflation is basically stripping out those the volatile aspects of the CPI basket, consumer price index basket, and it has been muted 2% to 2.2%, as earlier displayed in the presentation. And that is what is speaking to a more challenging environment. That economic demand in the economy is not there. Partly could be also the high interest rate environment that was there, which has stifled the demand in the economy. And also from a fiscal perspective, we saw what happened around third quarter last year, the riots that played out, which somewhat constrained the demand in the economy. So this year, at least there's a more what you call some optimism from where we sit right now, some base-off effects, because last year was a bad year. This year will be at least favorable, better year for businesses. Hopefully, the government authorities can now be able to also support the economy. We've seen from the monetary policy, interest rates have been reduced cumulatively by around 2.25% since July last year, August last year. So that could also support credit mediation, which has been stifled. We've seen private sector credit growth has actually reduced 12 months to December last year, it reduced by 1.4%. So potentially, and when the CBK comes to reduce this central bank rate, it's not automatic that banks will adjust them as fast as CBK would want them to be adjusted. So what you saw in the month of February, which was last month, a bit of some stick approach to banks to be able to adjust their lending rates in unison to where the CBK rate is, and potentially that could be able to revive some credit mediation activities in the economy. On the fiscal, obviously it's been a challenging bit, more so within the context of the IMF program, which is coming to an end this month. And looking at the IMF program, it's a loan, yes, but there are some conditions that Kenya needs to meet. But if you look at those conditions, one of them is fiscal targets, revenue targets, what you call budget balanced budget targets. We've not been able to meet the fiscal targets, the revenue mobilization, and that also feeds into the challenging environment that we have in what we normally look at as statisticians or economists. We look at some of the data that is coming out. The data for the revenue, the first 7 months of the current financial year, which started in July, speaks to things such as consumption taxes, that is value-added tax, VAT, excess duty, has performed below par, and that speaks to a more constrained environment. So potentially you could see the authorities reversing that, which is part of what you call the medium-term revenue strategy to reduce the VAT rate, which could also unlock some of the demand in the economy. Back to the IMF program, also some of the structural benchmarks, these are the reforms that the government needs to do, be it on the parasocial side, be it on some of the requirements that they need to perform. So it has been unsatisfactory rather. So even as we are anticipating the final review, which could be sometime this month, there's also a likelihood that the final disbursement, which is roughly around $860 million, might not be disbursed. And that is also coming out clearly from the budget policy statement that was tabled in Parliament, that there's that possibility. So even if you start thinking about how will the successor program look like, we also need to bear in mind that based on the performance of the current program, based on the negative optics of an IMF program. Remember the genesis of the Gen Z protest was the IMF is the one which is sort of dictating some of the policies by the government. So probably the authorities might want to sort of play it a bit safe. So rather than having a funded program which has multiple conditions, there could also be a possibility of even having a structural precautionary facility, which was there in 2018. So basically, there's some money lying out somewhere. In the event there's some shocks, the government can be able to tap into it. Or we can have what you call some capacity building non-financed program. So it's a program by the IMF, no money is given, but just basically to ensure that the reforms are still there. So that's the long and short in terms of the macro. Onto the Kenya shilling, yes. So we've seen the stability since last year, the sharp adjustment that happened in February and March. So it's been quite stable, 129, 130 band. So even in partly agreeing with Femulele's assessment that it will still remain stable even over the course of this year. And it speaks to one of the sentiments that came from the audience is that what is the driver to it? And I partly agree with Wolfgang's assessment that these interventions by the CBK to purchase the shillings from the market is what is sustaining the shilling at this point, at this current level. So from where I'm sitting at, potentially you could see the stability within this 129 range for the foreseeable future. And obviously, from a current account perspective, it's narrowing, which is also a plus. So even giving the CBK some firepower to accumulate reserves. Thanks.
Thank you, Winston. I think just as a follow-up, I did not quite get your view in terms of where you see Kenya shilling interest rates, just to conclude your comments.
Okay. So the direction of travel is that you could see lowering in the central bank rate. This year we've seen 75 basis points, so 0.75% cut in the month of February. I'm still expecting a further 100 basis points in the course of the year, 50 basis points every other meeting. So the months of the next meeting is in April, so they'll skip that and probably cut a 50 basis points in June and also finally in October. So for cumulative, so for the central bank rate to come at 9.5%. They also did a reduction in the central CRR, cash reserve ratio, by 1 percentage point, which they intend will be able to unleash close to 60 billion cumulatively over a period of time, and that will also go towards credit mediation. So my best case, 9.5% by the end of this year.
Thank you very much for those comments, Churchill. I'd like to move to you, Rob. Could you perhaps give us a feel of what the current business environment and landscape has been like? And it would be good if for us you could factor in some of the current views in terms of an unpredictable tax topography, FX stability, and receding rates. But I guess what I'm asking from you is perhaps to translate what we are seeing in the macros to how it's impacting the business environment.
Yeah, thanks, Vuyo. When I thought about this question, I thought of exactly the same Chinese proverb as you. Maybe we live in interesting times, and I wouldn't wish that on anyone after my experience over the last few years. For me personally, I'm logging for stability, a bit of consistency, the boring and the mundane. It's been a fairly challenging macro environment for the last 3 years, and I think it's been felt even more so on the ground in Kenya. That said, I think from a Hemingway's perspective, I think we're most well known for our portfolio of luxury hotels. We also have the largest corporate travel agency in East Africa. But we've sort of survived and done quite well post-COVID. In fact, the hospitality sector in Kenya seems to be booming, and we've had 3 record years as a group. So it sort of made me think about bucking the trends and going against or not conforming to economic theory, as we sort of touched on earlier in this forum. I think the macro environment has been challenging. I think it's been felt more in Kenya overall in terms of the business environment. But there are pockets or sectors that are thriving and doing very well. And look, I think a lot of it is led by the US, and there's certainly some serious wealth generation in the US. And I think, obviously, Hemingway's sort of main market for our hotel business is the US market and the US tour operators. But even from a corporate travel perspective, we're seeing a good uptick in volume, and I think that speaks highly of what Nairobi is doing in terms of positioning itself as a hub for business, both regionally and on the continent. So, yeah, I think sort of mixed messages really coming from the business community. I'm aware of other companies that have found the last few years extremely difficult. I think as an exporter, probably the last few years has been better than if you were an importer. And I think in sort of certain sectors like tourism, like travel, are thriving and doing very well. But yeah, I think the macro environment certainly keeps us on our toes. The tax reforms that we've experienced recently have done that as well. And it's an ever-changing sort of landscape that you've got to try and stay on top of and manage. And out of that comes risk. And yeah, so for us as a business, risk management has been very much put at the forefront of our ExCom meetings, our audit committee meetings, our board meetings as well. And that's how we're trying to stay ahead of those risks and trying to manage those.
Thank you, Rob. And I guess just lobbing on from Rob's comment with regards to risk management, my next question is directed at Mr. Karim. How have you fared with regards to the volatility in exchange rates? I think one of the key things that we would like to get a sense of from yourselves is how have you been impacted by this FX volatility, and what are some of the risk management interventions that you've put in place to future-proof your business against some of this?
Thank you. So I think, as any exporter in this room would probably attest to, the last 2 years have been quite interesting. And I think this was alluded by, I believe, Philon, the economist, that, you know, the depreciation of the Kenyan shilling has not followed what I call the classical trend. And so exporters in this country have been faced with kind of knee-jerk exchange rate policies, whereby once you have a situation where you have a depreciation of the currency, so all your costs go up accordingly, and also your earnings are proportionate. But then when you have the shock like last year in February, March, where from a high of 150, 160, you're then dropping down to 130 in such a short period of time, and your costs have not even come down. Because remember, your costs are linked to past purchases or past performance. And so you have a situation where you're now taking exchange losses, which are quite significant on your bottom line. The argument that people put across to you is, but you benefited from the strong, from the strong dollar or the depreciated Kenyan shilling. Having said that, yes, we did benefit, but that benefit then is very quickly wiped off in terms of these shocks that we go through. In terms of trying to mitigate that risk, and because of this volatility, as an organization, we've always done forward covers, but we've done forward covers on our main trading currency. So whereas we know that the Kenyan shilling is linked to the US dollar, we then try to hedge our forward covers against our main trading currencies, which is probably the euro, the GBP, against the dollar. Just to get a sort of sense of, okay, we can live with this level on the international market, yet on the local market, because of the volatility, you tend not to work on that. And what you then tend to do is play a little bit on in terms of converting and depositing. And today was very good because you brought in another aspect, where you talked about the dual currency conversion. So those are kind of instruments that one would use. But I think as exporters, and I'm talking about traditional exports, and traditional exports in this country have been tea, coffee, horticulture, we're suffering. We're suffering because there are lots of challenges, not around exchange rate alone, but around the whole, what I'd call business environment. Your costs are going up, they're not coming down. So Kenyan shilling costs are all up. You've got policies within national and county governments that hit you all of a sudden. So you don't know whether tomorrow morning you're waking up to a new levy that's just been placed on your truck that's coming through from another part of the country. You wake up in the morning and find that the airlines have now pulled all the freighters out of Kenya because they've got better rates out of China. So now you're left with situations where your market cannot be serviced. So there are lots of other factors besides currency that really have pulled down what I call traditional exports, to the extent that it's not predictable anymore. I mean, I've been in this business, and I was talking to James. I mean, James and myself have been been in this business for too long, and we've gone through various regimes, and some of you might not even have known. But in Kenya, we used to have a very strict foreign exchange regime, where foreign exchange was tightly controlled by the government. You could not get allocations of foreign exchange unless you applied for it. Your foreign exchange earning was taken into the bank, and then the rate was determined by the central bank. You could not even access that same money unless you applied for it. So, I mean, those are kind of regimes we've come from. So When you talk about interesting times, it's historical, it's generational.
Thank you, Mr. Karim. I'd like to also turn to you, Kiptus, and I guess it's just building on what's clearly coming through as a thematic in terms of the requirement to be agile if you are doing business in Kenya. From your perspective, also as an exporter, are you able to perhaps share with us kind of your strategic mechanisms that you employ to manage FX risk? And I guess any other risks that are coming through on your balance sheet and from your operations. It would really be interesting to hear what are some of the strategic imperatives that you've undertaken to manage FX risk and any other market risk your business faces.
Thank you, Vuyo. I'll support Karim. Exporters, I think nowadays we don't sleep. You wake up and then all of a sudden your cargo cannot leave JKI because of space. So those are the things we always fight for. In regards to Forex, from the perspective of floriculture sector and also our industry as CN, we've really worked closely with Absa to do like aging and forwards and zero callers. That is on the side of managing that volatility in terms of Forex. But also what we've done is we've tried to diversify so that we no longer rely heavily on one major currency. So like for now, we've moved predominantly from Europe to UAE, from other countries, so that you end up getting mix of currency. Then you're able to hedge so that you match your paying and the other things. But by and large on that, it's really given us more stability, and we've seen like we are able to mitigate some, but not on the major side. But the other, which we can't mitigate, is of course the ups and downs of tax policies, the ups and downs of, but at least it's not as bad of. But majorly working with the bank and also trying to diversify source of revenue.
Thank you, Kiptus. I think that one is very interesting. Diversify the hard currency that you receive in your business. And I guess with what's happening now, the US and the EU kind of dynamics, that's quite a win on your side. And I now turn my eyes in-house. Michael Alem, I think you, as our coverage team, are always the voice and the face of the bank to all our clients. So I think at this point, it would be opportune for you to perhaps speak to the room with regards to what are some of the measures that Absa has put in place to support clients through this particular interesting season that we've seen ourselves in, and how do we continue to position ourselves to support our clients in this current volatile environment?
Yeah, so thanks, Vuyo. So I guess as a bank, we really look forward to some of these sessions because we have these discussions with our clients literally almost every day. So straight to your question in terms of what do we do as a bank to be able to walk through with our clients in their journeys and mostly to navigate these cycles. I think from how our business is built, there's a lot of agility and there's a lot of inbuilt predictability across some of these cyclical horizons. So even if you had to break it down in terms of interest rates from the macro perspective or whether it is on the currency side, what you do is that over and above our conventional business, we endeavor to be able to inbuild more or less risk mitigative structures that tend to predict some of these challenges in the client's journey. So as we deal with our bread and butter, transactional, trade finance business or debt financing, we speak to our clients essentially just to be able to probably take a rear view in terms of how some of these economic cycles have played out in the past, what were the consequences, factor in all the macro environments and probably what's happening across the globe in different parts of the world. If probably there is a hint that there could be a cyclicality of whatever nature, we tend to be able to take care of it in advance. And when you do it in advance, probably the cost of building it in is essentially cheaper, unless when you go in when there's a storm in the market. So that is the mindset around our business. Really, for a bank like us, it's not really, we smile when our clients walk through the journey successfully. When our clients struggle and they're hit by some of these waves, you struggle to smile at fee income or interest coming into your account, yet the client is literally getting everything out of their savings to sustain the business. So the mindset is to be able to predict, have clients have very broad conversations, try to unearth some of these instances and then factor them in terms of our banking facility structures upfront.
Thank you, Michael, for those comments. I'd like to, because I'm mindful of time, I'd like to open up to the floor and just ask if there is any comments or questions to our panel. I think that this is such an important dialogue for us to have as both businesses and as the bank. So please, I urge the audience for your participation. Do we have any questions or comments for our panelists, please? There's a question.
Thank you so much. My name is Sam Maina. I'm representing a company called Equatorial Nuts Limited. My question is maybe to Kiptis, and you talked about the diversification strategies that you are using to mitigate against all these challenges. But I wanted to understand, how about the issue of AFTA? You know, the Africa integration. There's a lot of talk about that. And are you taking advantage of that? And is there seemingly benefits that we may expect out of AFTA, Africa Continental Free Trade Area?
Okay. Predominantly, the industry I am is floriculture sector. And we could have loved to benefit so much from it, but we get challenges in that the African culture has not been a floriculture flowers uptake, in exception of South Africa and partly Nigeria. So we are seeing it might only benefit us more, not much, but limited, because again, our inputs still come from China and Europe and the other sectors. So it might only benefit us if probably even you buy flowers to your wife or your girlfriend, then we can have a demand picking up for that. But in terms of the products we have, we don't see much. But in terms of a country, I think it will be very good, because we'll see free flow of trade, and then it means then that the things we import probably, it could be like fertilizer in Morocco can come easily, and then it can actually lower the cost of production as much. But we are not seeing it in the first step, but probably the second level we can be able to witness that.
Thank you, Kiptis. May I ask Mr. Karim also to reflect as someone who's in agriculture for the food part of agri?
So I think, first of all, I mean, and this has been a question, and I know Anthony in KAM has been in these conversations with us for a long time. You know, it's a real mystery. As Africans, we can't trade with each other. I mean, the amount of trade that we have within the African continent is so minuscule, and yet they will import what we could produce quite easily from Europe or anywhere else. I mean, I'll give you a simple example. West Africa, which is kind of like, you know, in the continent, the products that I produce are shipped out to Europe and sold in the supermarkets of West Africa through the parent company, the supermarket that's importing it into Europe. When you go and ask them, why don't you buy from us directly, the list of NTBs, non-tariff barriers, the list of requirements for an African country to enter into those West African countries is so, I suppose, humongous that it's not even worth it. Now, as much as AFTA is trying to bring in this free trade agreement within the African countries, as long as the African countries and the people within the African countries don't realize that there is world-class production within the African continent, and that you don't have to go outside of African continent, we'll still continue having those barriers. We'll still continue having those cultural barriers, which first have to be broken down. I mean, I'm sorry, but even with South Africa, the trade that we have with South Africa is sometimes limited because of this notion that we cannot produce to sell out there. I think first and foremost there has to be a cultural shift. I mean, I've given you this simple example. What we've produced in Kenya goes up and comes down. Yet I can't do it directly. Why? So when you talk about the AFTA, it's a great idea, but it has to be followed through with some very strong political will, but also a cultural change within the people who want to trade in these countries. Thank you.
Thank you very much. Those are some very significant insights. Any more questions? I think while I give the room some time to ponder, I'd like to put our Director, Global Markets, on the spot. Michael spoke at length in terms of what Absa is doing from a coverage banking perspective in terms of supporting our clients through volatility. Stella, if you may, could you please expound on what we are doing as a global markets unit in terms of supporting our clients?
Thank you, Vuyo. Yeah, I know it's this coming. There's no free lunch. Good morning, everybody. I'll try and stand here, if that's okay. So I think it would be remiss of me, just before I answer that, just to share sort of how we are structured as a team, because I think that will then feed through what exactly we do. Because I was speaking to a couple of clients over break, and they were asking me, what is this Absa Global Markets? So I think there's a missing link. So with all due respect, a couple of the banks within the industry call themselves Treasury. I think you've heard that name, quite? So I think you're wondering, why are we unique as Absa? Why do we call ourselves Global Markets? And I'll try and demystify that. The reason why we call ourselves Global Market is we cover sort of 4 verticals. Those within those verticals that don't only scope the local market, but also scope what we call the global segment of it. So the first business that we cover is what you guys are sitting here today. So the client is the heart of the bank, and for us, that's very critical, and that's where we're here today. So we have what we call our sales business, and that business is led by our Director of Sales, Nicholas, if you don't mind, if you could just wave. So Nicholas runs our business. I was making a joke yesterday that Nicholas is the newest director in the bank. He's just been promoted, so I'm very proud of him. As you can see the way I'm smiling, so really happy to have Nicholas here. And what we do in the sales business, and that's what you're sitting here, we've sectorized ourselves to cover every client in the industry. So be it you're a corporate client, whether you're a small, medium enterprises, or whether you are yourself or myself, sort of what we call the consumer, or what we call the retail client or the wealthy client. I can see a couple of wealthy people here, so I'm hoping that you're in our wealthy segment and banking with us. So in there, what we try and do as a markets business is to first try and understand your business. As I walked around, I kept asking the clients that I've not met before what exactly you do, and I think that's quite important. For us, we try and understand your business, see how the cyclical of your payments, your receivables come through, and then how we come in is then to establish whether you have any balance sheet risks that you're carrying across your books. And those risks could be A, foreign exchange, and I think Vuyo touched on it. And if you think about foreign exchange, there are a couple of aspects there. There's one, translation risk. Some of the companies seated here are not only domiciled in Kenya, but they do have presence within the global segment, and you do consolidate that. So you consolidate your subsidiaries to ensure then they feed up to your home currency. That comes with a bit of translation risk, and we do help you to manage that. I think the second one is around economic risks, or what we typically say focus risks, and those do come along just because of changes of the macro. It could be geopolitical, it could be just regulation, and then then you definitely have some foreign exchange, volatility that does come. And then the last one on that foreign exchange risk is what we call transactional risk, and I think that's a big one, because it just basically means by the time you transact and the time that you settlement happens, there's usually a lag. For example, here, a couple of you are exporters, you export to a different market. Maybe you're a flower farm, like Mr. Raphael here exports flowers into Europe. You earn in euros. By the time those euros come in, potentially there's a window of a week or two. That window is what we call transaction risk. And that comes, that's where we help you to manage that risk. I think that's one pillar. And I think in that, we don't only just cover FX. So we just spoke around foreign exchange. We cover all the asset classes. So we do have interest rates as well. We do, for clients like yourself who borrow, and you have a mismatch, you're borrowing on a floating rate, we help you to manage that risk. We're recently now starting to manage also local currency risk. So assuming you come to the bank and you borrow money on what we call the reference rate, which is your T-bill or government T-bill. I know the banks usually like using the reference rate, so you'll always hear Absa reference rate. But there are some clients who are seated here, borrow linked to the T-bill, and we really help you manage that. I think that's also another area we do. We do also commodity hedges as well, and we also do a couple of equities. So I think that's one of the sales business, that's where we sit. So in there is, I think what's important is before you start doing a hedging program, please talk to us. I think it's important you put what we call a hedge policy framework. I'm not sure in the room who has a hedge policy in place, just by show of hands if you don't mind. Great, I know, yeah. That's familiar. Del Monte as well, good. Yeah, so a majority of the clients also have what we call a hedge policy framework. And I think that's important because then it helps you to understand how do you gonna come in to utilize these products we are talking about. When is the right time? How frequent do you do it? What are the risks you look at, And I think that's quite important, and we do help clients do that. So then you don't have a reactive way of transacting, but more of a consistent manner. And if you talk to the clients who have a hedge policy, you've actually seen over a long time, they actually see the benefit of hedging because that consistency does help. I think that's one subset. I think the other one is what we call the trading business. I know Wolfgang, our director for trading, left, but he shared his insights around the dollar cares. He runs, basically what he does is they utilize the bank's capital, which is part of also your liabilities, but we are careful. We do have mitigants to it. We don't just go and balloon the capital. So we utilize the bank's capital to make money, so we take positions. So in primarily that business is interfacing what we call the government security. So we buy a lot of bonds and bills and trade with them intraday to try and see how we can make some money. The third business is the digital, which is quite important. And Lily Washira, Lily, if you don't mind, just stand up, just wave the crowd. I don't know that you can see her, but she's on the corner there. Lily is also our executive who runs the digital. And why it's important is twofold. One, I think it's important for us to give you a platform where you're able to trade efficiently and be transparent. I don't know by show of room, how many of us are utilizing our digital channels? Could I just see? Okay, we are doing badly, Lily, you can see that. It seems like we have to do a bit more there. So yeah, so we do have a couple of platforms that we offer, both across the segments to help you utilize your FX trading needs. I think that's quite important. And why it's important is it just eliminates that human face. Sometimes you could be traveling, you could be anywhere, and you're looking to take advantage of the market. Some of those platforms have what we call, you can actually place an order. You can actually say, if dollar cash touches 129.50, please buy 50,000 from my account. Because then you don't have to keep watching. You guys are busy. I think treasury function is potentially maybe 10% or 20% of your day job. So I think it's good to utilize those platforms. But more importantly, in that area, and you'll see in a couple of, maybe a month or so, one of the items we're looking to do is to put up a mobile app that will be going to the market. I wouldn't talk about the name today because my colleagues will be like, you're spilling our secrets, so I'll let it come to the market soon. We'll give a mobile platform to help clients like yourselves to be trading on the go. I think majority of the platform right now, you have to log in onto your desktop ETC, which is making it very cumbersome, especially for what you call the small, medium enterprises who are always on the move. But more importantly there, one of the things we're working on is to try and see partners we can work with. And if you think you're this partner, we're looking for partners where we're going to interlock our ecosystems to see how do we integrate everybody. You have your suppliers, you got your customers at the end of it. How do we integrate that FX movement across? Because all that vertical has an FX need. So I think we're looking for partners. We've seen telecoms is maybe an easier way. We are talking to a couple of them, and you'll try and see us going to the market also to integrate with them through the ecosystem. Then lastly, our last pillar is our Absa Securities Limited. It's a 100% subsidiary of the bank. I'm sure of you, I hope some of you invest in stocks. I've been saying the other day, Kenyans need to stop investing in land. I used to be a corporate, but I've stopped also investing in land. I don't know how many of you still like land and buying buildings. So I think in a way we need to start thinking differently. So we have that business that does stock broking. So they basically do equities and fixed income brokerage. We also have listed a gold ETF, and this is important. It's an exchange-traded fund in the Nairobi Stock Exchange that's traded in local currency, but references the gold price. So again, talk to us as a retail investor. It's one of the best performing asset class. I think gold has been the best performing asset class. Last year, year-on-year growth, even with the shilling appreciation. Shilling appreciated from 160 to where we are, 130, 129. Because remember what I said, it's referencing in local currency, so what that means, standalone, it references the gold price, then you multiply by where the dollar shilling market is trading. Even with that shilling appreciation, the return on that gold ETF was north of 17%. I think I would like anybody in this room to tell me which is the investment they did and they were able to get that good return last year. So fantastic product. So please reach out to us. I see our general manager for that business is not in the room, Paul Nyaga. But we had a session yesterday with the non-bank financial institutions, and we were very fortunate and lucky to have both the NSC, CMA, and RBA in the room, again, just speaking around that alternative asset class. So we were very privileged to have them there to speak on that. So speak to us on the gold ETF. I encourage you. I don't know whether I can buy it. I've been asking whether I can buy it, because then it seems like you can't buy what you're also supporting as a business. So I'm not sure that James, someone else can buy for me, but we'll take that online, because it's a very good asset to buy. I think the last one on that business is we do help clients like yourself to raise funding. I think all of you in this room, you're always looking to expand. Traditionally also, you come to the bank for your normal loan, but utilizing that Absa Securities Limited license, we can actually help you to go to the capital market and raise funding. So I want to encourage, let's try and start doing commercial papers. I think it's something we've done in the past in this market. Commercial papers are not getting traded anymore. We can help you do that. We can help you raise a bond as well. I think it's in the public domain. We did help EABL raise a medium-term bond 5 years ago. That was quite a lucrative bond. We were able to raise for them 11 billion. And who are these people who help give you the money? Your asset managers, your pension funds. They're always chasing for where to place their excess liquidity. So please talk to us if you want to raise some funding. We can actually help you through the capital markets and utilize that license. I think, let me stop here. I hope I've covered. Have I been too much? Extreme side? Thank you.
No, but thank you very much for that comprehensive oversight. I think it helps, I guess, to give out the business architecture in terms of how we support clients. But I'd like to please revert to my panelists and ask Rob another question. So I think we've spoken at length about financial risks and the global landscape. I'm quite curious to understand your view, especially with regards to what's happening with the US and some of the narrative that's come through from Trump. How do you believe that this would affect the business landscape, and how will it affect the destination markets that you look to?
Okay, quite a challenging question. And I think it's just quite early to sort of forecast accurately. I think, as we've said, there's a lot of uncertainty in front of us. But at this stage, this early stage, I'm not sure you would sort of bake it into your base case scenario. But a sort of a downside scenario I see, I'm worried about where interest rates might go. I know there's been a lot of talk about interest rates coming down and coming down quite quickly. Then it was all about interest rates coming down, but much more slowly than we first anticipated. And now with sort of the Trump effect, I'm slightly nervous and thinking about contacting the bank about some interest rate hedging products, because I am a bit nervous that the interest rates might start to go back up if we see inflation going back up. So that's one thing I'm mindful of. I'm obviously mindful of FX risk as well, and you know, the two sort of go hand in hand really. So an increase in interest rates and in inflation could then lead to a depreciation in the shilling. That's good for our business. We're a dollar earner. Most of our costs are in shillings. But it's just more uncertainty that you need to navigate through. And so it's looking forward and thinking what to do. But in terms of sort of the business, the hospitality business, sort of, you know, we're fully focused on Kenya at the moment. So it's all about inbound travel into Kenya, and that seems to be remaining very strong. As I said, there seems to be good wealth generation, particularly in the US, despite what's going on. And it's just a bit strange, but it does seem to be the trend over the last couple of years. So we don't see that dying down. Domestically, the market is tough. We don't do a lot of domestic leisure business, and we don't do a lot of corporate hotel business. We do a lot of corporate travel, but not corporate hotel business. And that's, I think the corporate side is okay. You know, it'll be interesting to see what happens with Trump slashing aid budgets and things like that, and freezing them completely. I think that's going to have an impact on the corporate environment here in Kenya. But yeah, I think domestically, the domestic market is definitely depressed. People are tightening their belts. The tax reforms haven't helped. So, you know, everyone's paying more tax or more levies, and I don't think that's really helping the domestic travel market from a leisure standpoint.
Thank you, Rob. I think, Mr. Karim, I would perhaps ask you to also expand on the same with regards to the views in terms of what the headwinds coming from the US and Trump's current volatile stance on everything. What do you feel is the impact of that on trade and disruptions to trade, and how does that translate, I guess, to the export business that you run?
So at the present moment, and Rob's probably right as well, is we don't know what's happening. We don't know where it's going to go and what's going to happen. Obviously, there are lots of negative soundings coming out from that side. And as I mentioned earlier in the session when I gave some comments about AGOA and all, that's a big one. I mean, you know, we must understand that from a Kenyan export perspective, AGOA has been a driver for exports out of this country to the US. It's the primary export. There's some other exports that are very small in percentage, but the textile or the garment industry is a very big one. And we've grown over the last 20, 25 years from being a very small player to, I think we're now, if I'm not mistaken, are we number 1 or number 2 from Africa? I think number 1 now. So, you know, it's quite a big one. It's quite a big one. And so any tariffs that will be put on, it'll probably be relative. So again, I think I heard some sentiments from a gentleman across the room saying, you know, where are the alternatives for the garment industry, for example? And he's right. I mean, you know, there's going to be trade-offs. But at the end of the day, consumption is going to be then driving the demand. So if U.S. consumers, who are going to pay for it, if tariffs do come through, as much as the wisdom is saying that it'll be produced locally in America, there's some things you can't produce in America because it's too expensive. And there are industries that require manual labor. There are industries that require what I call not high tech, and therefore those industries will still be based outside of US. And as much as they would then put tariffs against those as well, it's going to just create inflation in the US. Inflation in the US again would mean Fed rates going up. Fed rates going up will then translate into, you know, other issues for currencies in Africa. And so it's just going to be a spiraling circle. So as much as, you know, we hope things will not pan out to where we think they might, we just have to hold tight and sit back, you know.
Thank you very much. I don't know, Kiptis, if you would want to lend your voice as well in this regard, please.
It could be interesting to watch what will happen between Europe and Ukraine-Russia issue, because for us, predominantly, our market has been Europe. So we don't know whether the push and pull will cause a lot of inflation in Europe and our products demand goes down. That is the big question we have. When will that happen? I don't know. But again, that calls for diversifying. Like we are looking maybe to UAE for our products and other countries. So, but basically, I feel that if consumption is affected, of course, it will trickle down to us, the exporters.
Thank you. Churchill, perhaps also your view then, especially with regards to Trump, his cut on a lot of foreign aid, US aid closing. I think even the US food program offices have closed. They closed in Johannesburg last week. I think that we're going to start feeling that here. What is your view in terms of how this would perhaps cause some imbalances in the overall macros in Kenya? Do you see this as a potential risk factor to the Kenyan economy? And if so, how do you see it translate?
Yeah, thanks. Fully agreeing with my fellow panelists' view that there's a layer of uncertainty. This whole issue is still fluid, so as to be able to sort of have a more coherent answer what will happen if this risk crystallizes. But to your question around Trump, so there are a number of issues that have been touched on. So on the foreign aid aspect, I think the freeze was for 90 days. So obviously it's telling us that it could go either way in terms of which countries will be deemed more vulnerable and they may not even get the full hit of the freeze. But with Elon Musk, with all this dodge happening there, so you can see the kind of direction the policy will go. But if I may sort of zoom into the AGOA, last year there was one of the acts that was in Congress. This is the AGOA Extension Bill 2024, which spoke to potentially extending it by another 12 years to 2037, as it's coming to an end in September this year. So I'm thinking and sort of dovetailing with a comment that was made earlier in terms of the foreign policy, Trump being sort of a deal maker, because I'm seeing the scenario whereby AGOA is not extended. There's another country that may come in, and this you are looking at the China, because there's been China has made some inroads into the continent. So that probably might tip the balance for them, America, sort of trying to extend it. And if you look at the numbers, from the US exports, the trade balance between US and Africa is around $49 billion, which is, the US is running a trade deficit, basically getting more exports, they are receiving more imports from Africa than the exports that are coming from US to Africa. So that's the trade deficit is coming from. And if you look at even the AGOA, the numbers that I saw last time as of this 2023 is around $1.1 billion. So there's still more scope in the event that AGOA is extended for the players within the African continent to be able to, the apparel industry to be able to grow in the next 12 years. So that's the potential where it's coming from. And over and above the trade, we also look at investments, because we've seen a number of firms from the US also starting to look at investing in Africa. The previous regime under Biden, there was what is called the Strategic Trade and Investment Partnership, which started bearing fruit even in Kenyan market. And also this whole extension of the Mombasa Expressway, which will be it's a big ticket investment, which potentially could now lead to more investment. So I think there are a number of angles to look at it around the trade, the Trump effect on the African continent, and in particular into Kenya. Yes.
Thank you very much, Churchill. I think it's without a doubt that the Trump effect remains a risk factor to watch out for. So at this point, I probably just want to briefly summarize what I've heard from our panel this morning. The business environment remains tough. It remains riddled with uncertainty. But in the midst of that, there is still a good opportunity to be had. If I heard correctly from Rob, even in the midst of what is happening in the US tourists are still arriving on Kenyan shores. Wealth is still being accumulated in the US. It's the wealth that comes here for tourism, and it's the same wealth that then comes through for investment. And I am also of the view that it's the same wealth that fuels our portfolio flows. If I am understanding also correctly from Mr. Karim, and both from Kiptis, is that as an exporter, foreign exchange remains something that is a significant factor to look out for as an exporter business, but that the exporters in the room are not sleeping, not only due to the foreign exchange risks, but to certain other interruptions that their businesses are incurring, things such as difficulties with freighting, and uncertainty with regards to some of the internal legislations that are here at home that could suddenly impact how your logistics of moving your goods happen. So I take a leaf from there, but I also take a leaf from all our panelists here that most businesses have risk management policies. And in those risk management policies, at least the FX part is covered quite extensively, and there's an FX hedging policy in most companies. And I would urge to all our clients who have a hedging policy or are looking to formulate one, that we continue to engage. I think even for a client that has a hedging policy, as an Absa bank, we still want to walk the journey with you as you adjust and refine your strategy that you implement under that policy. We have an economics house that we can put in front of you and your boards to help formulate your views, formulate your budget views, etc., on not just foreign exchange, on the greater macros at play. And I think it was just good as well just to have a bit of a round robin understanding that the Trump effect is a possibility that we must all be alive to. I think lastly, I'd like to turn a leaf from Mr. Michael Lelem and from Stella to say that the bank is here, that we want to understand your story, and engagement with you, constant engagement with you, only helps us to do that further. It also helps us to write our story of being a trusted partner and being a strategic ally of yours. I think I would definitely say, when I speak a lot to our offshore investments through our offices in the UK and in the US, Kenya remains top of mind in terms of an asset that investors want to buy. So conversations such as this help us to deepen our understanding of this market and of this economy and the greater business landscape. And I think with this, I would like to thank my panelists, Michael Lelem, Kiptus, Mr. Karim, Churchill, and Rob. Thank you very much. Thank you for being up here. I'd like to encourage our audience to please grab them over lunch and ask them the burning questions that you perhaps did not have an opportunity to ask now during this session. Thank you very much, ladies and gentlemen. Asanteni.
So thanks very much to our panelists for sharing your insights. We truly appreciate. When we came to you and requested that you come and speak to the audience and share the insights. So truly appreciate for that. And maybe as a show of appreciation, we'd want to give you some small token. So if you don't mind, maybe I can be assisted to remove the seats. We need to appreciate them with some gifts. And James, you can assist us to appreciate them. So let's have the seats removed, and then you can come on stage. So thank you. Just requesting James coming up, and then our panelists, kindly, maybe you can come on stage so that you can be able to award. Start off with Rob. Thank you very much. Please, let's clap for them. Mike, I can see at the far end, so yes. So thank you, Mike, for representing the bank. A clap for them, tafadhali. Up next is Churchill. Thank you very much. Let's give them a clap. So thank you very much. A clap, a clap. Karim, finally. Thank you very much. Thank you very much. So Stella, you can come on stage and we can do the photo Vuyo. I also see Nicholas kindly come on stage, our director. So Alex, sure. I don't know whether we have any top executive. Absa. Good, thank you very much. Let's please give them a clap. There's a big gift after lunch for Vuyo, so really thank the panelists for taking their time. So I think maybe the other bit, James. So maybe the other bit, and I think the people we kind of tend to forget is the team that is watching us online, on LinkedIn, on YouTube. So wherever you are, we truly appreciate you taking time to listen to us. We could have hoped you are here. You're about to have some lunch, but it is what it is. So, but again, we appreciate. So I know the media team will be sharing the code for the feedback session. So kindly do scan the QR code. So we can take the next 1 minute, max 2. Kindly maybe get your gadgets, let's scan the code. It is good to give feedback. We want to hear how the session was. It's something very brief. So kindly scan the QR code. In a minute, then should be okay. Thank you. I think we are good. So maybe before we come for closing remarks, I think really want to appreciate your time. This particular morning session, coming and listening to us. I know there's so many learning points in terms of what we can be able to do for you, the risks that are out there, and our capabilities in-house. So truly appreciate. Do reach out to us, and we should be happy to have those engagements and conversations. I think with that, I want to introduce our director and head of markets, Stella Mambo. Please, Karibu. Let's please give her a clap.
Thanks, Victor, our MC for today. Good afternoon, everybody. Actually, it's good morning, but going to afternoon. I know I'm standing before you in lunch, so please don't leave. Let's have lunch together. I think my role is very minimal here today, which just speaks to when you have a good machine behind you, right? Do you agree? When you have a good machinery behind you, then you do less and less of work. So I'm just going to try and give my closing remarks. I also try and recap for the day. But I'll start off with, of late, just because I'm growing old, and I know some people say, you're not growing old. I'm actually growing old. So I kind of like history. I never used to like history when I was young. In fact, I struggled in my history classes. But I was just going through some of the events that have happened over the years. And on the 4th of March, 1933, and seems like the US is quite topical now, Franklin Roosevelt was inaugurated as the 32nd President of the United States. And what was amazing on his inauguration ceremony, he said something which is so provocative and something I think we could take away from this session today. He said, and I'll quote him, he said, "The only thing you fear is fear itself." And once he said that, that became almost his pillar corner around some of the deal policies he put through, be it changing the financial reforms, economic activities, as well as some of the milestones they had to go through in the US. And when I sit and listen today as we went through the session, I think the biggest thing we need to learn, all of us in this room, is then to say what we need to do. We can't go ahead and say we fear what's going to happen. we have to take a bit of action. And I guess for me, that's like a calling point. But let me thank the people who made this day quite a success. Let me start off with the speakers of the day. We kicked off with Pumelele. Pumelele and I have worked in our previous life together. He actually sat in Kenya, maybe he didn't tell you that, for 4 years, but not in the red machine, as I call it, in another organization. And Pumi is very constructive about Kenya. And I remember, Mr. Karim, you were trying to, but he's been very, very constructive about the Kenyan environment. And, he lifted a couple of things that we are seeing that are going on well from a lead indicator and some of the measures we take as a bank. I know there is a disconnect between some of those indicators and what we feel on the ground, but things to do with inflation, things to do with currency, things to do with how the interest rates have performed. The numbers are looking different from where we were last year. But I guess as we sit in here as a bank, there are also a couple of risks we are watching, and some of them we don't have answers, and we'll just have to see how they reform. I think the big one for us now is the IMF support and what happens. We were very fortunate to meet one of the senior officers in National Treasury, and we got a confirmation. Actually, the IMF team is here today. Today is the 6th, right? Yeah, today is the 6th. They're here until the 14th of March. And we're really, really hoping that the reviews that they're going to do for the last program will really progress well. That could have an impact around both the interest rate environment and potentially the currency market. So I think that's a big one we're watching, and we'll wait to see how that goes. They're very confident from some of the discussions we had with them that there's going to be a rollover program. And from where they sit, they think that program will be still a funded program. I think there has been talk on the media whether is it going to be funded or non-funded. The feedback we got is likely going to shape up to a funded program. I think the other big risk event we are watching, obviously, is these geopolitical risks across Ukraine, Russia. How is that going to muffle? I think it's an interesting one. We do hope things are going to stabilize. We saw that having effect around supply distractions, commodity prices, and actually it will affect majority of the economy. I think that's something we need to watch. Debt sustainability levels, I think it's something we all, here, has an impact, especially on foreign investors. And as we've all said, capital flow has been good, especially both on the stock market as well as the bond market. And that actually has supported the currency where we are today. If that is not contained, then that we could start seeing a bit of what we call capital flight. And we do hope some of the fiscal deficit to GDP, I know the government potentially, I think in the new budget, Pumi, correct me if I'm wrong, still projecting about 4.9% fiscal deficit to GDP. Their target is 3%. What that basically means, because the expenditure is about 21% of the GDP, then they have to raise revenue about 18% of GDP. I guess the question is, how do we raise more revenues? I hear people saying we don't want to be taxed more. And I know Pumelele has been not a darling when he says Kenya is not taxed enough. So I guess the question is, how as a country do we raise more revenue to be able to meet that physical deficit to GDP? Because it's important, because that's also going to have a strain, both on interest rates. But the good news is, I think rates are falling. So we do want to extend our hand as a bank and say, come talk to us. I think good time for you to take a bit of CapEx if you're looking to expand. Banks have now reduced interest rates, including ourselves. I think we've gone to the market. There's potentially still easing on the monetary policy. You've had that. And obviously that then will translate into the lending rates across. And I think that's positive for the economy. I think, moving quickly, I think the other one, just to touch on debt sustainability, we picked up during our discussion, is the liability management that the National Treasury or the government is employing. I think we all know that they are trying to extend what we call duration, or extend the length of their borrowings. And that's what you're seeing in the now near term, actually beginning of this year. The primary auctions have actually been concentrated on the long end of the curve. Seen them come into the market to raise funding, potentially in 8 years and above. So again, trying to lengthen the tenor of their borrowings, because they still believe that long end of the curve, on the yield curve, is still very attractive, and they could be able to raise some funding. So I think that's something to watch. And the last one on that space is that the 2027 maturity that they just re-extended it or repurchased, again, was a good outcome and just speaks to, again, that liability management. So the theme there is they're going to raise, they're going to lengthen duration, but more importantly also cut on any syndicate or commercial loans that are expensive. And I think that's a good strategy if you ask us what they're trying to do. So I think all is not lost. And then we moved on to Vuyo Mafrika, our executive for client solutions across ARO. I must admit, because I'm a firm believer in giving back to what is real, Vuyo actually mentored me. So I'm actually very thankful, and we've worked again in my previous life with her. And it feels like we're all family, right? Does it feel that? That everybody here is all family? So Vuyo, thanks so much, spoke around the risk management solutions. So I think primarily today we touched on FX. I've just said we have other asset classes we look at. So please talk to us on interest rates, on commodities, etc. So thank you very much, Vuyo. And then Ri Molefe, our legal executive, also who sits in Joburg, spoke about the legal framework. I think it's important also, as you enter into these solutions, ensure that you have a good legal framework in place. It's important to have the right documentation. Let's exchange the right set of documentation between yourself and the bank. Because, hey, we've seen things also going wrong. And also things can go right. So just have your legal decks in a place. So thanks so much, Ri, for that. And then lastly, to our panelists, I think thank you very much. The only thing I noticed, and is almost maybe a conscious bias, and it's something maybe we just need to look at. Everybody was men there except Vuyo. So I think next time we need to do better. So I challenge my team, Nicholas. I think let's have some ladies on the panelists. But thanks so much, Rob. Rob, Finance Director, Hemingways. Rob and I also go a long way. We've worked, or rather we've partnered in different places that he has been working. So Rob and I go a couple of years ago. Churchill Ogutu, the Economist IC Group, lovely. Thanks for giving your insights. And I like the way you challenged Pumelele and said, I agree with this, but here I have a different view. That's what democracy and also giving that feedback is. Mr. Karim, CEO of Spychem, thank you very much. I know you've been a big support to us. Thank you so much, I appreciate. And then Rafael Kiptis, the group CFO of Cian. Where is Rafael? Rafael, again, also our, we can say buddy, that buddy in the heart. Eh? So Rafael also has been a good support to us, helping us just to take the bank to the next forward. And my colleague, Michael. Michael, thank you so much. And Michael, I can't see you. But Michael is also a senior relationship manager within the coverage team. So thanks so much. I think that was a very provoking session. And also we do take some feedback there. And then lastly, to our coverage colleagues who helped put this event. I know I did introduce the global market executive team, but I think there's a coverage teams. I've seen, I think a couple of them have left. But obviously, James as a managing principal or managing director for that business, as well as Elizabeth Wasuna, who's not here with us, but I'm sure some of you know her. So thanks so much, and there's other RMs. And then the marketing and corporate affairs team. I saw Mary there. I think she's walked out. Mary is our executive also who supports us as a corporate investment banking. They made this event quite a good success. And then to my media team down there, they've been telling me, let's do a video, let's do what. I don't like all those things, but I guess it comes with the job. But thanks so much for making this event a good success. And lastly, to Kempinski, I think good food. Encourage you to join us for lunch, and let's share a meal together. Thank you so much, and have a good day. Thank you. Appreciate it.